Okay, looks like the microphone is working. So thanks everybody for joining. And I'm hoping to start having more Q&As maybe on Saturdays over the weekend for the foreseeable future. And my overall hope with these Q&As is one, it's an opportunity to talk about the Brooks trading course, answer questions, talk about overall trades, just anything people have questions about. But also, my hope is to start incorporating how does one move forward with the Brooks trading course? What do they study? What should they do? If they've whether they've been studying for a few years or you got the course yesterday, what is the path to move forward? So with that said, no sound. Testing. Okay, what about now? The sound should be working, and I'm going to give it a second to make sure it is. Okay, perfect. We have good sound. So let me, now that we're good to go, I will start over. So my hope with these Q&As, what's the point behind these? Obviously, it's helpful at the end of the day to be able to ask questions and get your opinion on the market, ask about anything over the end of day. But I want to start once a week at a minimum, really answering Q&As over trading in general, the Brooks trading course, maybe pieces of the E-mini or what to do with Forex. My real hope with this is to help those out there as far as what do you do with a what do you do if this is day one, you got the course yesterday? How do you proceed? What do you do if it's been a year? What do you do? What are the best ways that people have found to study the course? So with that said, let's get started. And I'm looking through questions right now. And the first thing I want to kind of state and maybe discuss the obvious, and that is you have to take the time to review the video course. A lot of people, they're always asking, what's the optimum number of times to view it? And that's a bad answer. The optimum number of times to watch the video course is whenever you're satisfied with your information and learning of the Brooks trading course. And I would suggest that that timeline to get there, you should plan on studying the course. You never stop studying the course. Because if you think about it, if you're studying the Brooks trading course, you're really studying Al's methods to trading. And whether or not you're watching the videos, you're reading the books, or you're looking at a chart, you should be thinking, what is this? What's this pullback? All the little details, parabolic wedge, what do you expect? So when you're studying a chart, you are also studying the the video course. Now, day one, most people, I would suggest most people finish the video course before they really start trading because the reality is you've got to be able to learn the information well enough to apply it on a chart. Now, a lot of people are way past that point, but that is something I think is easily overlooked. You can't pick and choose which videos. There's a reason there's over 100 hours of videos in the course. So I'm scrolling through some of the questions right now. James says they got the course yesterday and they're starting at the beginning. That's very good. And James, one thing I will tell you is This has always been a complaint with the video course, but there's no real way around it. And what that complaint is, I'm going to turn this off and fix this. I switched computers for this webinar. But one of the complaints with the video course is it seems confusing because one is, give me 1 second, we should be good to go. Okay, perfect. It's confusing because on one video, Al's talking about trading ranges, but then on the next video, he's talking about wedges and he hasn't covered wedges. That is why you really have to watch the video course several times. Trading is, it's not that simple to explain each subject one by one. You can explain it in pieces, but if you if I'm explaining breakouts and you don't know what a trading range is, you're going to miss out on some of the valuable information with breakouts. That's why you have to really watch the video course over and over, because when you start to learn about parabolic wedges, why did this just get an endless pullback and sell off? The more you start to understand about parabolic wedges, the more you'll understand about this piece. After taking the course, when do you get access to the encyclopedia? That's another good question. What I would say about this, one, you have to wait 60 days for various reasons. But the reality is, if you somehow complete the video course in 60 days, then personally, me, I would wait at least 6, 7 months before even really looking at the encyclopedia and really get a grasp on the video course. Because your first goal when you're watching the course is to be able to just understand the overall pieces. So let's look here. Here is a screenshot of all the videos. And I know it's hard to see, but let's think about this for a minute. I'm just going to scroll until it stops. Think about and pay attention to the minutes. Those of you that have seen the video course, those of you that have studied Al, you know that when there's a 43-minute video, it is very in depth. Even a 21-minute video is in depth with a lot of information. So to simply say that you're going to finish all this in 6 months is not realistic. So the first goal I would have when I'm studying is I want to be able to know every one of these videos. And the first piece is if someone was to come in here and quiz me on what is this video? What is support and resistance? Can I at least understand the bullet point? What's a round number? What's a list of support and resistance? What are types of channels? What does that mean? At least can I give a 20-second overview on this video? That's goal number one. And I want to do that for every video. So I don't want to learn everything about gaps the first time I watch gaps. What I want to know is what's a gap and what's a moving average gap bar, just the very high level. And then I want to go down here, always in. What's the basic understanding of always in? The goal should be this: to be able to go into the trading room and pull up one of Al's videos, or go back to any point, just find any trading room video with Al talking and be able to follow along with what he's saying. You're not going to get every piece of information, but you can at least get the overall concept. That's the number one goal. Once I finish the video course and then I have a decent grasp of where everything is, I'm going to keep watching the videos. Then I'm going to dive a little bit deeper into, maybe I'm just going to pick a video, trading ranges. I want to know that a little bit deeper. But it's going to take a lot of viewing time at a minimum. The second piece I would say is really make it a goal. Everybody's got different amounts of time that they can dedicate towards studying. But at a minimum, you should be watching one video a day, 2 videos a day, 3 videos a day. And for me, it sounds silly, but if I was cleaning, I would have the video course playing in my phone. Or if I'm cleaning with the vacuum, have the video on my phone. It sounds a little ridiculous, but the point is, even if you can listen to the video course from audibly and not even see it, that is still something. So your first goal is to completely submerge yourself into the course. Why aren't Al's videos indexed better? Well, trading is not that simple of a thing to explain. The longer I used to wonder the same thing, and the longer I've studied Al's video course, I really would not index it any different. This is actually it's a very smart way to explain the Brooks trading course, and it really is. And the longer you see the longer you watch the video course, the more you will understand with that. But I agree, it just takes a lot of time. But the goal, it's designed to really build on each piece. How can you trade after working hours? Forex, E-mini, is there any difference from working hours? So my first question with a lot of these, with a lot of these questions that are going to get asked, I'm going to go back to the video course, and for you, I want to ask you, have you seen all of the video course? Because this answer right here is in the video course. I'm willing to bet that if I go to the one of these videos, basic charts, price action, somewhere in here, chart basics, price action, we are going to be able to see this answer. And the answer is all price action is treated the same. So for me, if you can't watch a 5-minute chart during the day, trade Forex, trade a 60-minute chart, trade a 240-minute chart. Your number one goal is to get really proficient with understanding the video course. So what would I do? I'm going to go to, here's a list of Forex markets. I'm going to hide myself just so we can better see. Here's a list of Forex markets. And by the way, if the screen's blurry, if you follow my mouse on YouTube, I don't know about Facebook, but YouTube, there should be some sort of settings icon up here, or if on your phone, maybe it's below the chart. You should be able to click on it and change the quality depending on your internet connection. Anyways, the first thing is let's take a 60-minute chart. If that's a reasonable time and you can keep up with it, trade a 60-minute chart. You have a really big bull breakout. So if I buy that close, guess what? There's at least a 60% chance I'm going to get a second leg. So buy, put your stop below. But a 60-minute chart is a lot of risk. It is. So trade smaller. Trade even when you're starting out. Trade just one unit. Risk $1. The great thing about Forex, the longer I trade, the more I actually really, really like Forex. I used to really hate it and I was bothered by it. And I was bothered by it because I was trying to trade a 5-minute chart. And when I'm trading a 5-minute chart on Forex, here's the problem. This range is huge. So commission, the bid-ask spread, none of that is an issue. But if I'm trading a 5-minute chart, and let's go to here. This big bar right here is, well, actually, this is a little bit misleading. So I'm going to go to a different day. The range is actually really big right there. Most days in Forex are not that big. So here's a range, these bars. This bar is 6 points or 6 pips right there. 10 pips is still pretty high in transaction cost for most people trading Forex. That's why I'd really recommend trading like a 30-minute chart, 60-minute chart. But the longer I look at Forex, the more I realize it has really, really good movement. And the longer you look at charts, the more you're going to learn that charts are the same. One of my favorite things to do, and I'm trying to do it more and more, is to start making charts. And it doesn't matter what it is. I've got several Forex markets. Here's a Forex market. Here's a 5-minute chart of the dollar yen. But remember what I just said about 5-minute charts? They're really difficult to trade because the bid-ask spread, it's usually pretty steep. The commission is a little steep and the range isn't big. But there's several. Here's a 60-minute chart of the dollar yen. And either way, the whole point is by drawing and building charts, you'll start to learn that price action is really all the same. We'll talk more about that here in a bit. So back to your question, what do you do if your time is limited, you've got to pick a time frame that's suitable for the time you have to watch the market. But that does not mean you skip over the video course. What broker do you use for Forex? I've used a lot of Oanda, but I'm in the US. And the US, there's not a ton of Forex brokers. There's Oanda and Forex.com. All of them are pretty much the same. So I'm very, well, I've not used Forex.com as much, but I probably will at some point. Give me 1 second here. So here's a question. What are the keys to improving the win rate on swing trades? Is it more about picking better entries or management? Well, the way you worded this question tells me that you already understand the answer. The answer is both. Win rate and the trade management will always get you a better winning percentage. One thing I realized, actually asked Al this question, sent an email just anyways years ago, but I remember Al would always write the end of day charts. He would always mark it up with stop entries, and he still does that on a regular basis. So you can go to the Brooks Trading course to see that. But one of the things I noticed on all the stop entries is there would be a ton of them. There'd be all sorts of stop entries on a chart. And I remember thinking, just like everybody else, Al, if you took all of these stop entries, you're going to lose. How do you're going to take a beating. But what it dawned on me was even on days like this, if a trader could sell below this bar right here, it's hard to see. It's a second entry short. Yes, the bar failed. But what if a trader sold below that bar and got out within 2 bars and took a 1 tick loss? Then they wouldn't take a big loss. If a trader, even right here, trader could have sold below this bar and still gotten out break even. So one of the things I would think about with swing trading is if you're trading a breakout, in other words, you're buying above a bar, selling below a bar, you really want the market to go your way really quickly. So let's find some examples here. Like right here. Here's a bull bar. Let's say you bought above this bar. Consecutive sell climaxes, maybe a wedge, bear breakout, few legs down. But if you bought above the bar, I want to ask people in the chat, what does Al say about tight bear channels buying above a bar? What's the general probability? Give me a range. Is it 60%? Is it 10%? Is it 30%? What do we think it is? Okay, 40. Let's say it's 30, but you're close. But it's basically somewhere around 30 to 40. Now, if you're taking a 40% trade, you're taking a low probability trade. What do you want to see out of this trade? You want the market to go very quickly your way. So if your risk is small, look right there. You're happy with that follow through. That's good follow through. So what traders will do is this tells traders that a lot of traders didn't scalp out. Therefore, they might be willing to hold for a little bit longer. And you can see it started to drift up. Even right here, if you bought above this bar, it's a terrible buy. Lots of bear bars down. But a trader who bought it, what are they hoping for? They're hoping for maybe the world's biggest bull bar on the next bar. They know they're not going to get that, but they're taking a chance. And if they do that and they get that bar, they're thinking, yeah, it's kind of disappointing. I don't know. Maybe I'll just get out. And look, even when they saw this bear bar, you could have gotten out basically break even. And that's exactly what traders did. Now, what I would recommend as far as what are the key ways to increase your win rate and pick better stop entries and management, the first thing is for most people that trade the SPY or the most people that trade the day only session, whether that's the globe, whether that's the ES.D, the E-mini, or the SPY, I would wait if you're trading a 5-minute chart, I would wait for 6 to 12 bars before placing a trade. The reason is 80% of the time the market goes sideways on the open. Consecutive bull bars, but look, it still went sideways for the first hour. This is a rare situation where the market just sells off entirely. Most of the time, the market's going to be disappointing. Here's an open, sideways, sell off, reverses. So waiting 6 to 12 bars will help. The other thing is I would try and find a dominant feature of the day. That is in, Al talks a lot about that, but always in is basically that. You're trying to find a strong feature, strong breakout, something that's dominating the chart that's going to lead to follow through. Like right here, big bear bar, another bear bar. Traders are selling. So selling in this area is a good idea. Now let's talk about trading for a minute. Most traders are going to be way better off trading the SPY than the micros or the E-mini. Why? Because they can trade really, really small. Micros, it may not seem small, or it might seem small to some, but a lot of traders, they will have an easier time if they start trading very small, where they just don't even think about the risk. So, how do you train yourself to sell as this market's going down? You have to trade really small and just enter a position. If you trade the SPY, you can trade one share, and if you're a U.S. broker, you can basically trade one share and have almost pretty much zero commission, minus maybe a couple of pennies. So, a question about prop firms. I'm going to speak in generalities with that. I've never done one, but I know several people that have. I'm going to assume that most of them are legitimate. I don't have a reason to assume that there's anything fraudulent about them. The one thing I would say about them is, you know, for one, well, here's the question: how are trading programs like any prop firms such as Apex making money from people like me and others when we pay a $30 discount and blow $1,500? Is that money real that we get or not? Well, I don't know the answer to that because I've not done Apex and I'm the wrong person, but I'm sure you can Google that. But what I will say about prop firms is they're reasonable. I think you have to be careful. No matter what you're doing, you have to view things as far as what is the capital you have and what a risk is appropriate. So, $100,000 account where you have full access to that $100,000 is way different than $5,000 where if you lose 5,000, you go zero. You will lose your capital. Now, the reality is, if someone gives you $100,000, even if you give yourself $100,000, you're not really allowing yourself to risk that $100,000 because most traders are not going to allow themselves to blow $100,000. At least you shouldn't. So, a lot of traders have to have a way to be able to manage risk appropriately. That's why I go back to the SPY. You can trade extremely small and get really comfortable with what you're doing. Can you explain a little bit about buyers below or sellers above? That's limit order trading. I've mentioned this before, but one of the things you could do this with simulated. Please don't do it with real money because it is it's not a good idea. But one of the things you'll notice, let's just go to a random place. And by the way, this is 2022. This is September of 22. I was looking back on older days for fun. But what you'll notice about limit order trading, which is buyers below, sellers above, is most of the time limit order traders make money. So what do I mean by that? Traders who sell above this bar right here and scale in are going to make money. Bulls that buy below this bar and scale in lower are going to make money. Look at this chart for a minute and play a game with yourself. I've done this on simulated. I think everyone should try it. I would not use this as a trading strategy because it's an easy way to lose a lot of money. But what I would consider is fade everything on the chart. So when on the first bar, buy below the bar and scale in lower and scale in lower. On the second bar, sell above it, scale in, and scalp out. Do that back and forth. And you'll notice even the traders that bought, let's say this bar right here, and they bought more lower here and here, they made money. A bear that sold the low of this bar right here. What do you notice? Those bears made money. They sold, they scaled in higher, they made money. A bull that bought this close way up here and just scaled in lower, even as the market was going down. What do we notice? Look at this bar. They made money. Limited order traders almost always make money. Now, there's instances where they get trapped and they get into a lot of trouble. And that's kind of a situation like this. Obviously, if you sold anywhere in here and you kept scaling in, you were going to be punished and take a big loss. But it's really important to understand most breakouts pull back and allow limit order traders to make money. So let's take a look at some more questions. Okay, question. Brad, what would you say is an average time you would hold a trade for a swing? I'm asking because it may help myself and others to practice holding their trades longer. I'm starting to get my head around the probability game with your explanation of 2-to-1 risk reward. I'm just thinking maybe an average time to hold could help too. Yeah, that is a little bit of a subjective question, but what I would say is this. If you're taking a swing trade, let's go to a random chart. Let's go all the way back here and let's just find the next trading day. Okay, so here's the open. So if you're taking a swing and let's say I buy above this bar, just a random bar, this bull bar. And one of my, one of my expectations for a swing is if I'm buying above any bar, I'm basically betting on a breakout. I'm betting that momentum is going to carry me forward. So if I buy above a bar, I want the follow through to go my way rather quickly. Okay, it went outside down, but for the sake of fun, let's pretend I bought and put a stop, maybe a measured move down on the bar. Or who knows? If I didn't buy this bar, let's say I bought that bar. Okay, there's a bar, a bull bar, but it's a little bit small, disappointing. I don't know, maybe it's not ideal, but it's at least follow through. And then there's that bar. So we hesitated. So the bears that sold this high and scaled in, they're making money. Does that look like something that's going to lead to a strong breakout? Or does that look like something that is going to lead to disappointment? And then we have this big bull bar. Now, because you had overlap here, a lot of traders might see that as part of a trading range and just scalp out. And instead, we have more follow through. So traders are buying and then more follow through here. Now, let's take this for a second. The trader that, well, first, why did this rally happen? Because bulls like me who said, this is a gift, let's just take your profits, they got trapped out of a good trade. So they had to buy again and chase the market. This is what you want to see for a strong swing. If you're buying and the market's racing up quickly, you're going to be tempted to take your profits. What about this day? If you bought this close and the market keeps rallying and going higher, you're willing to hold and give the market more time because your actual risk was pretty small. Let's find an opposite example though. Let's say I want to find a day with a lot of trading range trading because that is most frequent. So let's see here. Here's kind of an example. So let's say you bought above this bar and you see all this overlap here. The market's going sideways for a lot of bars. The pullback was almost the size of this breakout bar. If you bought, chances are you're going to be fairly disappointed. You buy above this bar, Small bar, overlap, more overlap, even more overlap. Even if you rally for a couple of legs, what do you think this is forming? It's forming some sort of a trading range. You know the bottom of the range is somewhere down here. You don't know where the top is, but it's reasonable to assume that the top of the range might be somewhere around here. So we may go a little bit higher, but even if we do, we didn't actually go that much higher. We basically stayed there and sold off. So why in the world did traders take profits here? The traders that bought here and held for a swing, why did they start bailing out here? It goes back to right here. Now let's go to a more relevant day and talk about this because we had this happens all the time. Whenever traders trade breakouts, they're trading the first leg of any move. Let's say let's pick an example. They sell this bar. They're hoping that the move never ends. But realistically, they know that's not going to happen. And they're prepared for disappointment. So they scalp out. A bull that buys here, they know the reality is after a big sell off, if you bought above this bar right here, you're going to find it's going to be a trading range. And we might get above the highs. But even if we do, we're going to be disappointing. We're going to be disappointed. So a lot of them start to scalp out. If they see a bull bar, another bull bar, a climactic bar, that will give them a little bit of a reason to hold. But if we go to yesterday, right here, here we have a rally, a second leg up, maybe it's a first leg, bull bar, and a close above the moving average, another bull bar, climactic bar. It's a strong enough rally that it'll at least probably go sideways to up. But notice this, if you bought anywhere, here was the follow through, a lot of overlapping bars. That's enough to make the market in a trading range. And because of that, think about what I talked about a few minutes ago. Traders that were long, and this breakout has problems. Strong breakouts, I talk about this in the trading room pretty regularly. Strong breakouts look like this. So it's hard to see, but a strong breakout has little overlap. You have bars that are equally strong. They're not climactic. You don't, if you buy this bar, you don't all of a sudden get a 20-point bar and you take profits. And even over here, so if we go back to this rally looks different. Now, back to the overall question right here about how long should you hold for a swing. First, I'm always measuring, okay, what does the stop entry look like? If I'm entering a breakout hoping for a couple of legs up, how strong is the breakout? This is okay. It's enough that we're probably going to go higher. But if I have to sit here for 15 bars or 10 bars of sideways trading, that tells me that the upside is going to be disappointing. Even though the bulls got a second leg up here, what you have to realize is this right here, this area that I was just talking about, this is enough to make the market in a trading range, which means this whole area is a trading range. And I know that's kind of might sound confusing for some traders. These bull bars are part of the trading range. Remember, so I'm curious in the comments, who can tell me what a channel is? A channel is a transition between what? And it goes back to the market cycle. So, what is a channel? It is a transition between what two features? A breakout and a trading range. Great job. So, a channel means it's the transition point from a breakout and a trading range. And what that means is this channel up to this high is part of a trading range. We just don't see it yet. Now, if I was over here and I asked you in this green box, what is the market cycle? You would look at me and you would say it's a trading range, of course, because we had a spike pullback channel and we're testing the bottom of the range. That's why that's why channels often get retested and they in the start of the channel becomes an extreme of a trading range. We had another example a couple of days ago. Let me pull it up right here. Here it is. So we had this channel down to leg one and a lot of overlapping bars. If these bars are overlapping, this is a trading range. So let me ask you, if this is overlap and this is a trading range, what do we think this sell off down here is? Is this a trend? Is this a breakout? Or is this sell off part of the trading range? In other words, is this sell off part of the green box? It looks like a breakout. It's a second leg down, but the bulls are making too much money, which means it's kind of an invisible trading range. So what traders do is they expect after all of this, they expect this sell-off to lead to part of a trading range. And one way they measure it is right here. Here's the extremes. They say, I don't know if the bottom of the range is going to be here or here. It might be at the bottom of this measured move, but it's somewhere. That's why you hear Al in the video course say that whenever limit order, whenever counter trend traders begin to make money, especially with stop entries, the market's in a trading range. Look at this day. We had a sell off, big second leg. What do we notice about this right here? Bulls making money. So, what am I going to say? Here's a green box. This is the start of a trading range. What am I going to say about this sell off? I've just talked about it in 2 or 3 separate examples. So, what is this? Is this a bear breakout? Yes. But what is this also that might be invisible right now? Who can tell me that? Remember, this box gets expanded. Exactly. Tyler says part of a trading range. This box gets expanded. So whenever bulls start making money, everybody assumes the market's in a trading range. Sell to close? Yes. But everybody exits above a bar. And the reason is they expect this. This box, let's see how long the price action gets contained. For several bars. We had an example. Here's an example from last Thursday, if I can find it really quick. Here's an example from last Thursday. We had a trading range and this really big sell off. And look right here. We had bulls making money above a bar. That makes the market start to evolve into a trading range. And this is the Globex session. We sold off a little bit, which was right here. But the Globex session tested the top of this orange box, which is right here. So I hope that's helpful. Okay, let's look at a few more questions. By the way, one of the first things I really would study first, and this is after you've watched all the videos in the video course, I would really start to think about the market cycle. What's a breakout? What's a channel? What's a trading range? And really be able to identify what the market cycle is. Second, I would understand major and minor reversals. Strong reversals like this, they're still minor, but they're strong enough to at least evolve the market into a trading range. If we think, another way to think about that is this right here. Let's try and draw this with a pen. I've never used this, but let's see if it works. So this move down looks like this. It's drifting down. And one way to think about it is people often use the analogy of an aircraft carrier or a really large barge in the ocean. I was reading something about, remember I was listening to a documentary, and it's one of the aircraft carriers, a new one that the US built, I don't know, 5 or 6 years ago. And what they said was it's such a large aircraft. I think it's like 3 or 4 football fields long. In order to stop the aircraft in the ocean, it would take, I think it was 3 miles for the before the aircraft would come to a stop. And that's including, and anyways, the whole point with that is that's how the market cycle is. When you have a strong trend that's selling off, it doesn't go like this and then reverse. It sells off real slowly, and the brakes get turned on, and it starts to channel. Then it starts to go sideways for a long enough time, and then it can reverse. I know it's kind of not the greatest drawing, but the example, at least, it works. So whenever you have a trend, always assume you're selling off, you're going to get a trading range long before you get a bull trend. So let's take a look at some more pieces here. Okay, here's a question. It took me 6 months to finish the Brooks trading course. I now have hundreds of pages of slides and notes. What's the best way to assimilate the Brooks trading course info and move forward? It can be like drinking from a fire hose. Yeah, I used to think all the time. I remember I was always trying to find the secret ingenious way to study Al. And I knew two things. One, I believed that, for one, I was fortunate in the sense that I never studied really anybody else before Al. This was going back to 2013, 2012. And because of that, Al was kind of the first ever person I studied, at least, for a long time in the trading world. And what I really liked about Al was he had all this information, all this stuff. And when I looked at his books, it wasn't an indicator, it wasn't any sort of secret. It was just very vanilla. Here's all this information, and it's hard to read it, and it's a lot of work, but it makes sense. The other thing that helped me was I was in Al's trading room for years, and it got to a point where, I don't remember when exactly, a year, 2 years, 3 years, somewhere in there. The more I studied and listened to Al in the trading room, the more I started to realize that what he's saying is actually really, really accurate. And the key with that is I went back on the old recordings after the day. So I would watch the day, I'd listen to Al, take some notes, and then I'd go in the recordings and really listen to Al. I would download the recording and listen to the day, and all of a sudden I'd realize even more features. But anyways, the point is, I used to always think, what's the most effective way to study? And what I learned was I spent far too much time trying to formulate an idea on how to study rather than executing the concept of studying. So I'd warn you is make sure you don't spend too much time studying, trying to figure out what to study. Sometimes I don't know what I'm going to study, and I'll pick up the video course and I'll just watch something, anything. I'll pick up the books and I'll start reading a chapter in the books. One of the things that I do a lot now is make up PowerPoint slides, and it's just a way to study. Or I'll look at random charts. I'll go to a 1 minute chart on Forex and just try and find patterns and just be more familiar with charts. One of the things I do a lot recently is comparing. So I'll look at one day, I'll pull up a 5 minute chart of a day. Here's that same 5 minute chart. And I'll study what a 3 minute chart looks like. Now, why would I do that? I'm not going to trade and look at a 5 minute and a 3 minute and make decisions on it. But what I want to do is better understand patterns. So here's this rally and this sell off. You can see it right here, rally, sell off. I know on a 20-minute chart, looks more like this. 30-minute chart, like that. So a 60-minute chart looks like this. And if I go even higher, it's going to be some form of a tail. Anyways, to answer your question, you take one day at a time and you study. The great thing about the Brooks trading course is the longer you study, the easier the information gets. Okay, question. For someone who primarily enters on stop orders and wants to experiment with limit orders, is there a setup you'd recommend? Yeah, I think don't take this the wrong way, but trial by fire is sometimes a really good learning method. But you have to do it in a means that's not going to kill you. So obviously, do it on simulated. And after that, try it on the SPY, trade really small. But what helped me with limit orders was just taking a lot of limit orders. Now, years ago, I tried a lot of limit order trading and when I was really studying out in the trading room, but I didn't know near enough of what I know now. And it would just crush me. But in order to really learn, first you have to really, make sure you understand the video course. But the two things as far as the limit orders, how do you get good with limit orders? Is for one, you have to realize you can generally take a limit order on almost any bar and make money, almost anywhere. There's very few exceptions where you're going to get killed trading with limit orders. So, what does that tell you? Then that means if you can figure out where you're going to get burned trading limit orders, then you know what to fix. So, if a trader can buy below bar one, make money, sell above two, make money, buy below three, make money, all the way down, and then they buy this bar. Maybe they bought the low of this bar or the low of two. Then there's follow through. Okay. So if you buy here and scale in, if you're not quick to get out, what's going to happen? Trader bought, they scaled in, they had a chance to get out, break even, or with a small loss. If they didn't take it, the market kept drifting down. So why did this sell off happen? Let's ask everybody. This is a really important concept to understand. What what fuels a breakout? And what I mean by that is what fuels a strong breakout? There is a two-worded answer. Starts with a T. Actually, both words start with the T. Okay. Tyler says buying back positions. Matt actually he's got the answer. So Tyler, you're right. All of y'all are right, but this is the answer. Traders that are trapped. So whenever you see limit order traders get trapped, then that's where traders start selling and pressing their bets. But anyways, if you're trading with limit orders, the first thing you have to learn is, for one, where are the trapped traders? So start identifying strong breakouts. Okay, let's look at some more questions here. Okay, question. When scaling in, when do you say you're on the wrong side of the market and it's time to bail rather than keep trying to make yourself whole? First off, the second part of your question is a really, really dangerous concept. Scaling in to make yourself whole. You should always remember scaling in is never, scaling in is part of a trading strategy. Scaling in alone does not fix a trade. So, what do we mean by that? Okay. Let's say I see two legs up and a bull bar. I'm going to buy the low of that bar for two reasons. One, consecutive sell climaxes. I know that there's probably buyers below this bar, but I don't know. There might be buyers at the low of the bar, but the buyers may not come in until the low close or the low down here. So maybe I'm saying that I'm willing to scale in a couple of times and use a wide stop. Give me 2 seconds. So if I did that, here is this big bear bar. And the question I'm always asking myself on any trade, whether or not I'm scaling in or anything, is my premise still valid? So if I'm buying below this bar, right here, would I still buy on this bar? If the answer is yes, then the trade is still valid. If the answer is no, the trade's not valid. And if the answer is if I was flat, I would be short. In other words, I'd be in the opposite direction. That tells me I'm on the wrong side of the trade. So to answer your question, it really this brings up an interesting discussion, and that is other people's money. Who can tell me from the video course why other people's money is irrelevant? There's an entire video almost dedicated to other people's money. And that goes right into this concept on the chart. So this right here, this question. Another way to rephrase that is because the money's in your account. Okay. Jacob's been studying the video course. The money's in your account. Matthew has too. He says it's not other people's money, it's your money. Once it's you're in your account, it's your money. Very good. So that makes me happy to see plenty of people have watched a lot of the videos. So, anyways, with that said, you should always ask yourself if you were flat, would you be long or short? So, if there's ever a moment where, let's say you're long and then you see this bar and follow through and you think to yourself, gee, if I was flat, I'd really start selling here. That's your almost flashing siren going off in your brain saying exit the trade and get short. That's why really good traders, you'll see it all the time. Al, he always talks about how he can enter anywhere and basically if he gets trapped, reverse positions. So let's find an example. Let's say a good trader, maybe they buy the close of this bar and then there's follow through and they start to say, yeah, you know what, I'm wrong. I'm going to, instead of be long, I'm going to get short and reverse. And the reason for that is if they were flat, that's what they would do. Do you wait for candles to close and do you trade the 5 minute? I trade a lot. Yes, I do trade the 5 minute regularly. Do I wait for candles to close? I do sometimes. If I'm wanting to enter on a breakout and I really want to see the bar close, then I will enter. I'll wait for the bar to close. But a lot of times I'll trade with limit orders. So if the market's going down, I'll sell or I'll buy below a bar. If I'm waiting for a stop entry, then I will often enter on a stop entry. Market orders versus limit orders. What's better? It depends on the environment. So if breakouts, let's think about it like this. Every the single most important question that one can answer, in other words, the single most important thing one can understand is breakouts. That is directly from Al's books. A breakout, by definition, is price going one minimum increment. So in the E-mini, one tick above or one tick below a bar. That is by definition a breakout. Whenever the market has a lot of overlap, that means breakouts are failing. Obviously, limit orders are better. Whenever the market has less overlap, in other words, right here, big bear bar, follow through, more follow through, limit market orders are going to be better. By the way, this Q&A, part of the reason for the Q&As is for one, it allows questions to be answered, but also it gives ideas on what would be some really good talking points to share. So maybe that's market orders or limit orders in this example, or how do you start out, or maybe it's always in. So by answering these questions or by submitting questions, it's giving good ideas on what would be most beneficial for most. So I'm looking through questions. Okay, question. Brad, how should we backtest in order to develop and test a strategy? Like, one, should we use the future bars or go bar by bar? Well, that is, there's many answers to that question. And one is, the first thing I would do is what really helped me is I spent a lot of time, for one, and maybe this is somewhat being naive, but also since Al was one of the first people I studied with trading, I did not really have any sort of bias, or I never really questioned if his stuff was legitimate. I just kind of assumed it was. And and while I studied, I was able to verify that more and more by hearing him talk about, the price action live in the trading room. And each day I became more confident that Al was being very truthful and his video course was legitimate. The information was real. This is really happening on a chart. And because of that, by being in the trading room so long, looking back, I realized that I never felt the need to really back test Al's information. I took it for what it was and I assumed it was accurate. And that also helped with really studying the course. So there's many ways you can do it. One is you can back test every idea, or you can take the opposite side and you can take everything that Al's saying and assume it's legit, or you can do something in the middle. As far as backtesting strategies, something that is, that gets into a very complicated matter. If you're just looking at bars, if you're just looking at charts, it's one thing to just backtest. For one, you got to know what you're backtesting. So maybe you're backtesting second entries or strong breakouts. For one, you got to have a criteria to define what a strong breakout is. But for me, one of the ways you can call it back testing, I don't know if I would. For me, what I would spend a lot of time doing is looking at the video course and charts and really just through time seeing more and more about the price action. But if you're looking to develop or test a trading strategy, that is what I would start with. Here's what I would start with. Let me pull it up. So I'm going to turn the screen off, but give me 1 second because I want to talk about this, but also I want to give you an example of what would probably be the most effective. So give me just a second here. But for the most part, I'd be very careful about backtesting. And what I mean by that is you have to really know what you're trying to backtest. Pulling up right here. There we go. So this is going to be a very simplified example of a flow chart, but this is how I try and think about the market in very simple terms. The market's in a trend, and this is straight from the video course. The market's in a trend or a trading range. If it's a trend, it's in a breakout or a channel. Is it a breakout or is it a channel? If it's a channel, is it tight or broad? If it's tight, only trade in the direction of the channel. If it's broad, trade like a trading range. Is it a breakout? Is it strong or weak? Is it strong or weak? If it's strong, enter at the market. If it's weak, enter on a pullback. Is the trading range tight or broad? If it's tight, wait for the breakout. If it's broad, fade the upper and lower one third of the range. Now, why is this important? Why is this overall concept important? And this gets into something called, if you think about trading, systematic trading, if you will, there's really two ways you can trade if you really break it down. One is you can trade discretionary, like Al. He looks at a chart, he is totally discretionary. Or you can trade, let's take a hedge fund, for example. You can trade with computer programs and automation. That is the other side of the coin. Both ways are systems. Al Al may not seem like he's trading a system. He kind of looks like, think about it. Someone once told me that a professional trader like Al, they are like an artist who can just pick up a paintbrush and just start drawing on a wall. And they instantly know exactly what they're drawing. They don't need to look at any documents. They can pick up a brush and just build something. And or a very skilled craftsman who can just build furniture by looking at it. That is a really good discretionary trader. A system like an automated system is the exact opposite. It's the Henry Ford of cars. They're building as many cars as possible on a production line, where someone like Al would be more of a Rolls Royce example, where everything is customized. But what traders have to realize about trading is the more discretion you have, the more trading knowledge you have to have. Both traders are building both traders are building systems in some way. So Al's got the ability, if I had to guess, Al can think through this from a subconscious level. So when you hear him talk about binary decisions, his brain is mentally going through this decision tree. Now he's done it for so long that it's almost instant. He doesn't have to think about it. So when he's looking at a chart, his brain is almost like a computer algorithm searching, going down the decision tree. And it's the exact same way a computer would do it. So if you're the first thing I would really suggest back to your to give you, to tie this answer in, the first thing I would really work on is decision trees. How do you distill the market cycle down? Don't worry about any of this down here. Worry about, is the market in a trend or is it in a trading range? What are the key elements? One of the things that helped me, and I still look at it occasionally, let me see if I can find it. Give me 1 second here. So I'm going to turn this off. I'm not going to share this because it's a lot of Al's information. But I started building a lot of flowcharts on just various things. Here's various goals of a market. So the goal of the market: force traders to trade, find a fair price. What happens when there's a fair price? All sorts of things. And anyways, the point of all of this, signs of a strong trend, these characteristics. The reason I built that was for this. I started trying to make myself think more in terms of binary decisions: trend or trading range. If it's in a trading range, is it tight or broad? Is it in the middle of the trading range? Yes. Wait for price to reach the extreme. No. Is it at the bottom of the range? And obviously, I never really finished it. And If it's in a trend, is it a breakout or a channel? So, anyways, I could talk forever about flowcharts, but I think they're a really, really effective way to help formulate your brain into thinking in certain ways. So, everybody thinks differently. I'm very big on flowcharts. So, that's just what works for me. Okay, let's look at some more questions. What is your opinion on scaling out of winning trades versus adding to them? First off, scaling out of a winning trade makes a lot of sense. Most traders, I would start with scaling out of trades before scaling into trades. And that's another effective thing about using something like the SPY. I can sell a breakout, put a stop above, and I can take partial profits. I can take partial profits at one times my initial risk, and maybe I trail the balance. So that is an effective way. As far as adding to winners, most traders should not do that, but plenty of traders will. They'll sell more, sell more, sell more, sell more. They get a bull bar, they'll be quick to just get out, break even. But those traders that are adding to positions, they're going to be entering, they're going to be exiting their positions very quickly. So they're going to exit very quickly because their position gets rather large. If 80% of breakouts fail, doesn't it make sense to be a scalper? Well, sure. So that's kind of the evolution of a trader. The longer you look at charts, for one, when you start looking at trading and you start looking at the video course, everybody realizes that inherently scalping makes the most sense. But scalping also requires a lot of information and knowledge. So most traders are better off learning how to swing trade. And there's several reasons. One reason is if you're going to scalp, you have to understand swing trading because you have to understand what's a major and minor reversal. In other words, a different way to say that is what's a leg in a trading range and what's a leg in a trend. This is the trend. This is probably a trading range. Now, quiz question for everybody here. We have a rally and two or three bars, overlapping bars here. And I look at this and I think, bulls are making money. Bulls that bought this low and scaled in made money. So I'm going to draw that green box I've been drawing several times today. What am I going to assume? And even bulls who bought on a stop probably made money. So what am I going to assume here? What is the next sell-off probably going to be? Who can answer that for me? Tyler got it. Transitioning into a trading range. Nick says trading range incoming. That's exactly it. Now, an add-on to this quiz question. Is the market still in a trading range even if price falls below this measured move? So if price goes 1 point below this measured move, could we still be in a trading range? Yes, that's exactly right. Now we can get a strong breakout and morph into a trend, but we have overlap, bull bar, bear bar, bull bar, or doji, and price never reached it. And then look right here, rallied, more sideways, but eventually this box got a little bit bigger and the market formed a large trading range. But anyways, back to the question about scalping versus swing trading. I think you really, really have to understand swing trading first. And the best way to do that is always in. So you get this gap up and you start to get bear bars and you think, I don't know, maybe it's always in short for at least a few legs down. I'll sell. Okay, disappointing. Probably going to start to go sideways. Some traders will be very literal with always in, and they will exit when there's a second entry buy, for example. They'll exit above a bull bar. Other traders, they'll sell, they'll be disappointed here. They'll see this as a sell climax, test of the moving average. So some traders, they look at this bar testing the moving average and they say, yeah, it's a sell climax and it's probably going to pull back. So if I know the market's going to pull back, why would I stay short right here? Shouldn't I just scalp out and take my profit? And that's why that happens. So traders like Al, they can read the market so well, they know that this is probably forming into a trading range. They'll be quick to take profits. When the bulls get their rally, remember how I drew that green box and we start to sell off? If I'm a bear and I know that, why would I stay short? I know the market's probably going to test back up here. So this is profit taking. So back to that person who asked, when should you sell? When should you scale out of a position versus add to a position? You add to a position when the trend is present and you think there's a strong possibility of a second leg. When the market's forming a trading range, you will be quicker to exit. And right here is an example of a trading range. You get a small second leg, and then you get a reversal into a trading range. Okay, here's a good question. While we trade on a 5-minute chart, Al also has 15, 30, and 60-minute and daily on a chart. Yeah, it's basically this setup right here. What is the use of those charts? Kindly explain by giving some examples. Well, sure. So there's a couple of examples. One is, let's see here. A lot of traders, they will just have a chart up and let me just delete everything. So a lot of traders, when they're trading, they just have a chart and they'll just trade based on the chart. But if you're going to just trade really one market and you trade a 5-minute chart, eventually you'll get really used to all the other pieces. So if you keep looking at a daily chart, and let me get a sip of water because I want to explain something else. A trader, I remember hearing someone say, and this individual, it was actually Ali Offshari. For those of you that were at the Orlando event, you saw him along with Al. One of the things Ali said was a really good trader has imagination about a chart. And if you think about that, it's kind of like driving a car. So everybody, most people have driven a car in here. Think back to the first time you ever drove a car on the road with someone else, and it's a scary moment. You're driving a car, you've never done it before, and I remember the first time I ever did it. My palms are sweating, and I'm nervous. I'm gripping. You grip the steering wheel as hard as you can, and it's a very tense situation. But 10 years later, after you've driven thousands of miles, you're not bothered at all by driving a car. And that's kind of the same way with trading. The longer you drive a car, the more you can start to think about everyone around you. You can start to drive the car subconsciously and think about, hey, is the driver in front of you? Are they distracted? Are they, veering to one side or the other? Trading's kind of the same way. Someone like Al, who has traded for a really, really long time, they've got the ability to, they've watched the daily chart for a long time and they know what the daily chart's doing. So they can trade a 5-minute chart while being aware of the daily chart. Now, obviously, you're not going to do this with every, if you trade 50 markets, you're not going to do this for all 50 markets. But if you're trading, let's say you're trading the E-mini, and I'm going to use round numbers as an example just because they're the easiest thing to talk about right now. But if we've had several instances of round numbers. Here's 4,600. So I'm just going to draw 4,600. Excuse me. Yeah, 4,600 right here, this red line. Look how much it bounces. Test 4,600, 4,600. Tested it again. Went below it, turned up. Tried to get below it again. Broke below it here. Went a little lower, turned up. Opened, gapped below it, turned up. That's just one example. Now, what I would focus on for right now, for the most part, most traders should just focus on the chart in front of them. So at any day, no matter what day I'm going to trade, here's a random day. So what am I going to do? Here's the open of the next day. Huge gap up, gapping above everything. The gap's big enough, we're probably going to get a second leg, but we have a bear bar, so the market's rejecting the gap. It's probably going to go sideways on the open. I don't think it's going to go straight down, but I am expecting sideways. Okay, 1, 2, 3, maybe a wedge, some bear sell, follow through, maybe a small second leg down, possible expanding triangle, and then we got a bull bar. So that's disappointing for the bears, but 2 legs down, so probably get a second. There's your second leg. Now, why am I bringing that up? All I would focus on is the gap and the bars to the left. On any day, we had a rally, so probably sideways on the open, maybe 50% chance due to the buy climaxes late in the day that we form a trading range today. Here's yesterday's high. Rally, bear bar, rally, bear bars, rally, sideways. Is this going to last all day? I don't know. It probably won't, but it's a small pullback trend. Open gaps, it might. And then we got this big bear bar, but look at that. So still forming a trading range. You don't need to look at the daily chart. You don't need to look at the 60-minute chart. What you need is the chart in front of you. So let's see some more questions. Okay. How do you manage your trade when the market becomes always in long or buy the close? Do you buy the close of every bar? How do you manage your stop if you scale up? Yeah, this is actually a good question. So there's several ways. There's really two ways people will trade. One is they'll just hold until there's a reason to get out, and then there's others where they get out quickly. The more, and really, when you think about it, there's only one reason. I'm trying to find a strong buy the close. We'll use this. This works. There's only one reason a why a trader would scalp out of trades. So why do you scalp out of trades? Can someone in the comments explain? There's and I'll give you a hint. There's two features that are the hallmark of a trading range. One is confusion and the other's what? That answer is the reason traders often scalp out of moves. Reduce risk. That's kind of an answer, but that's not the answer I'm looking for. Starts with a D. I'm scalping out of my longs because I am what? Starts with a D. It's in the video course. Disappointment. Hunter got it right. I'm disappointed by the move. A lot of traders, when they're trading, buy the close or sell the close. So let's take your example over here. Not really a great example, but let's talk about a buy the close market. Or I'm going to find a better buy the close environment. Maybe this is one. This will work. So we have 3 consecutive bull bars right here. Give me just 2 seconds. Thanks everyone for being patient. So, um, let's go back to this question really quick. When you're trading by the close, when do you so let's talk about the question. How do you manage your trade when the market becomes always in long and by the close? That is very context dependent. So like right here, it's always in long, probably going to go at least a little bit higher. But what's the big problem with this chart? Look to the left. We're in a trading range. So this could fail and be a second leg trap. It'll probably have a second leg, but it could fail. Then we're starting to go sideways. So traders are buying, but we had overlap here, bull bars here. This is a buy the close situation where it's probably going to lead to a trading range. So traders will buy aggressively, but these dojis are a warning that something is wrong. And because of that, they'll start to scalp out. Oh, well, here, let me use this. This is an even better example. I want to find a bull example that's just really strong. And I just realized it's the first slide. This works actually even better. So let's talk about your question compared to this chart. This is the gold standard of when do you buy the close? And you've heard Al talk about it if you've been in the room. Al said one of his goals in trading is to start buying closes and just double his position on every bar and just use a tight stop all the way up. One way you can do that is you buy the close, put your stop below, and you're long here, put your stop below, put your stop below, put your stop below. And there's a reason for that. And the reason is, and another way you could do it is put your stop maybe 1 or 2 points below the bar. If you notice all the way up, bears never made money below bars until here. Most traders, now let's talk about the second portion of your question. Should you buy the close and scalp out, or should you just buy the close and hold? There's really no difference. That's why I think it's really, really important to always see yourself as if you're long, that means you're willing to buy and be long exactly at this moment. It doesn't matter if you're long. If you're not willing to buy again at this moment, you should not be long. So I don't know if that's answering your question as well as I could, but the key is expectation. Is this buy the close rally? Does it have a lot of overlap? Here, this is really strong. There's not a lot of overlap. And the way I define what's a strong breakout is how trapped are traders. We got an example here. Let me see if I can find it. Shouldn't take that long. Give me just a second, but it's I really want to show it. It's a great example of a stop entry that just trapped everybody as it was going down. Here we go. If you've been in the trading room, you've seen me talk about this pretty regularly. The way I define what a strong breakout is, and the reason why you want to define when is the market strong, when's there a strong breakout, you define it by how many trapped traders there are. This bar right here, here's the overview of the day. And you can see we had a strong rally, trend line break, and then some kind of a wedge. It's basically a double top. You can call it a lower high major trend reversal. And here's bar one, which is this bar right here. Now look to the right. The right is a 1 minute chart of bar two, the entry bar. If you're a bull, there's always traders fading stop entries. In other words, traders buying below bars, scaling in 1 point lower, 2 points lower, 3 points lower. They'll do it until they detect that they're trapped. And when they're trapped, they'll be squeezed out of the trade. You'll have other traders, when a stop entry starts to go down, they'll say, yeah, this is strong. I need to be short and in the market. I don't want to sell the close, but I'm happy to sell a pullback, maybe 1 point up, 2 points up, one tick up, two ticks up. Either way, they'll find a way to sell. And I remember this day. And I remember it because I tried to sell on a pullback for, 1 tick, 2 ticks, I don't really remember, but I could not get filled for a few minutes. And this is a great example. If you bought this low and you tried to scale in, you would have just been killed unless you were quick to exit. And look at the sell off, big second leg. So I'm always thinking about limit order traders. So let me look at some more questions, but that should answer your question. The first thing I would worry about, whether as far as scaling in or adding to a position, I'd worry about getting in the direction. So by the way, you'll see my eyes. I'm going this way and that way. I've got my screen split up. On the left, I use a 49-inch monitor, but I often have the screen split up with two different computers. On this side is the webinar, and this side is StreamYard. So when I'm looking this way, I'm reading questions. So I'm just reading through them right now. Let me look at this person. So here's a wish list. Could you and Al and the rest of the team make a list with about 70 points in one of the books with short, memorable bullet points helping us remember the most important things? Well, it's interesting you say that because that is actually two things. One, Eric, there's a list of bullet points in the books. You'll find I will I'm going to go back to this and we'll cheat for a second. But I can't show you all of this because this is a lot of Al's work and I want to be respectful of that. You see this? Signs of a strong trend. Where do you think I got all of these sentences? I didn't make these sentences up. I got them directly from the book. So what I did, I pulled out the book and on a Word document, I started typing. If you go to this chapter, I don't remember exactly where. Maybe someone that's more familiar with the books at the moment can put it in the comments. But there's a list of all of these bullet points. More importantly, I would start with the video course. If you go to the trading course, let me pull that up as well. We'll log in real quick. Not the beginning of the first book, but it's somewhere in there. Hmm. All right, let me see why. Give me just a second here. The computer's mad at me for some reason, so it's not letting me log in. But if I go to the bonus videos, and that's actually not true. If I go to it's in the fundamentals. If I go to the market cycle videos, I'm going to go to breakouts, signs of a strong breakout. I don't know what happens if I'm not logged in. And of course, anyways, the point is, if I go to the market cycle videos and I go to breakouts, signs of a strong breakout, video 15D. If I click on that and scroll to the bottom, there's a PowerPoint PDF that gives all of the signs of strengths of a strong breakout within it. So I would check that out for sure. I'm reading through some more questions. Question: do I listen to presenters talk while I'm trading? If you do you sometimes get confused if your bias is different? Yeah, I mean, I'll listen to at times everybody talking, but I'm also kind of I think a lot for myself. And what you have to learn with anybody, if you listen to anybody in a trading room or anything, number one, you got to take Al's advice. And Al's advice is don't listen to anybody, including Al. And what he means by that is you have to learn to fish for yourself and study. With anybody, I remember when I really started listening to Al in the trading room, he would talk me out of all sorts of trades and I'd be confused. But the more I studied, the more I realized, and I said, wait a minute, what Al's trying to tell me is there's something I'm missing. Al's trying to tell me that the market isn't as bullish or bearish as I think it is, and I need to be more cautious. But the longer I listened to Al, I could watch a market, I could trade a market, and listen to Al and not be bothered. And you can do that with anybody. But there's various. I think it's very. It just very much depends on what you're trying to accomplish. But one of the things that helped me, the more I listened to Al, and I'm only speaking for Al because that was the only person I really listened to in the trading room for so many years. So the more I listened to Al and would trade while listening to Al, I got more used to it. And you could do that with anybody. So let's look at some more questions. I like this question. So Floyd asked, how do you use your moving averages? So let's talk about moving averages. I have two moving averages on this chart. One is obviously a 20 period moving average, this blue line, nothing fancy about it. And the other, which is this dashed line, is a dotted moving average. It's a 20 period moving average of the 60-minute chart, which is right here. And there's several ways. I know Al wrote an indicator. For whatever reason, I'm not the best with indicators. I couldn't get the indicator to work. Excuse me. Let me get a sip of water. My voice always gets more dry whenever I start talking for a while. But anyways, I couldn't get the indicator to work. And for me, I try to keep it simple. So I used a 20 period moving average, and my input is 221. And that is close enough to basically a 60-minute moving average. So why do I have this here? For a few reasons. One, it's kind of like a big flashing red light. So when we gap up, here's bar one, bar two. This line is telling me, hey, we're really close to the 60-minute moving average. Maybe take a look at it. And here it is. But you don't need that. If I wanted to, I'm gonna keep it turned. I could turn it off, and you don't need it. I'm gonna keep it on because I'm gonna forget to turn it back on. Anyways, how I use the moving average is really simple. And if you go back to the blogs over the past few weeks, a good example is the daily chart. A moving average. There's something I've said. Let's play another quiz game. A moving average, and this is I'm taking this from Al. I didn't make this up, so please understand. I learned this part from Al. But a moving average is a something price. Can anyone tell me what that is? It's a blank. A moving average is a reflection of the blank price. I've said it tons of times in the blogs recently. So who can tell me what it is? Average? Okay, yeah. Fair and average. That's perfect. So we got it right. A moving average is a reflection of the fair price over a period of bars. So if we think about that, what does that mean exactly? This line means that over the past 20 bars, the average close has been whatever this line is. So if the market is all the way up here and the recent average of the past 20 bars is all the way down here, that means that traders are willing to pay a premium to be in the market. Now, if I'm buying a house and let's say I'm willing to pay 10% more than the value of the house in order to own that house, there needs to be a really good reason I want to own that house. If I'm willing to pay a premium for anything, there needs to be a reason for owning that premium. Right here is a good example. I'm paying a premium to be long in the market. I'm only willing to do that if I can justify that the momentum to the upside is strong enough for me to be long. If the momentum is not strong enough for me to be long, what does that mean? That means that I should not be long. So what traders will do is, let's go here. Big bull bar. We're above the moving average, but the momentum is strong enough that traders are happy to buy. Now we're starting to go sideways. That's a sign that traders are not willing to buy far above the moving average. Then we get this bar, and then this bar, and then this doji. So what is this telling us? We're starting to stall above the fair price. So eventually, if we start to stall for too long, what happens? Nobody's willing to buy this far from the moving average. And eventually, you've got to get down to the moving average. And that's what happened right here. Recently, I talked about this big outside down bar on July 27th, right here. This was everybody coming to the conclusion that the market is that traders are not willing to buy far above the moving average. They want to buy closer to the fair price. And that's why the market had to get down to the fair price. Eventually, traders are going to want to probe and see what's under the fair price. That's how I use the moving average. So on a 5-minute chart, I use it pretty simple. Let's find a big gap. Here's a big gap down. We have this big bear bar. We're far from the moving average. I know that the market traders probably will see this as the market being very, very cheap. And if the momentum starts to dry up, nobody's going to want to sell this cheap. They're going to want to sell when the price is higher. It's going down even further. Okay, that's good. But eventually, it's still going down. Eventually, we start to go more sideways, and nobody's willing to no one's willing to sell this far from the moving average when the market's going sideways. Okay, Peter asked, the Brooks price action documentation says wait for 5-minute bars to close, but sometimes I see a strong bar to scalp, but I wait for the bar to close. You say trade between bars. Yeah, well, I don't often wait for bars to close. And this kind of gets into, I don't want to get confusing. So let's talk about this. Here's a 60-minute chart of this bar, okay? And this was yesterday. Big bear bar. That's a sell to close bar. But somewhere over here, the market became always in short and is going lower. After 3 big bear bars, we're probably going to get a second leg. So for me, intra-bar, if I'm selling this close, I'm technically selling as the 60-minute bar is forming. So the point I'm making is no matter what you're doing, you're entering intra-bar on some time frame. Waiting for closes is important and it's a good thing to learn how to do. But if you start to detect that the momentum is going down and you're going to get a second leg, traders will start to enter at the market. I've got a slide on that I want to show. Let me just find it really quick. I'm going to be faster doing it like this. I just passed it. Should be the next slide. No, here it is. This is the dollar Canadian on a daily chart. Now, when you look at this chart, here's a big bull bar, and it's a second leg trap, two legs up, a lot of trading range price action. By the way, I can't really draw a green box because this is PowerPoint, but remember what I talked about with those green boxes? We have a rally, a lot of overlap. I was drawing that green box and I was saying the market might be in a trading range even if we get a second leg. That's what happened right here. But you can see this big bull bar on the daily chart is this rally on a 60-minute chart. And on the 60-minute chart, look what the market did. We formed a wedge, parabolic, 1, 2, 3, and we got an endless pullback and then a give up bar here. So, what a lot of traders can do is if they're looking at a daily chart, they're not necessarily, if they're very in tune with what that market's doing, they're not going to get out all the way down here. They might buy, and if they bought, and let's say in 5 or 6 hours, the market isn't going much higher and it's starting to stall, they might look at a smaller time frame and exit based on that time frame. So I hope that's answering your question. By the way, I see people talking about micros, and what I would really, for two things. One, if I had to pick between trading one E-mini and 10 micros, I would trade I would definitely trade 10 micros. I would rather trade multiple contracts of something than one contract, even if I've got to pay a premium and pay more commission. That's why I'm a huge fan of the SPY. If I had to pick between trading 50 shares of the SPY or one micro, I'm going to pick 50 shares of the SPY all day long. And by the way, I know a lot, I know it's kind of seen as, a badge of honor to get to trade one E-mini, but I would really argue that the person that's trading 10 micros is just going to be better off than one E-mini. Someone asked about Discord, and I'm going to put the link into the. I'm trying to find the link to Discord on the Brooks Trading course, but I'm having a little trouble finding it. So give me just 1 second. And by the way, I want this to be one of many in the future for these question and answers. And I want to start giving maybe mini lessons over certain things as we go on. If anyone knows how to post a link to the Discord from the Brooks, or where the Discord link is on the Brooks Trading course, please post it in a comment. Someone, I guess, said that is the Discord. So let's see here. I'm going to try one more place and then, anyways, it is somewhere on the Brooks Trading course. Let me try one more spot. Okay, why is it better to trade 10 micros? Well, it's kind of like this. Let's talk that gets into an interesting conversation about, let's take hedge funds or institutions. I often say all the time in the trading room that it's important to think like an institution. And we have to think about why that matters. Why is it important to think like an institution? And the reason is institutions have extreme flexibility to a degree. I mean, there's obviously certain limitations they have, but a retail trader, especially one starting out, maybe they're trading, let's say they're just trading one E-mini, and The problem with that, or they're trading one unit. The problem is my position size is always one. Eric, thanks for posting their Discord deal. So for those that can figure out how to copy it, there's the Discord. But if you're trading one of anything, the problem is you're stuck with that one unit. So let's say, okay, let's say the market's going down, but the risk is big. So I've only got one, really, I've got one choice. I can sell one unit and put my stop wherever. But let's say I didn't get in here. What if we're here? And I'm thinking, yeah, this is going down. I really want to be short, but gosh, the risk is huge. If I'm trading something like, if I have the ability to trade 10 micros and I want to sell, what can I do? I can trade one micro. So if you're trading one E-mini, the other reason, the more simple reason than that, most of the time the market pulls back. So 80% of the time, 80% of the time, you can usually enter on some form of a breakout. So that's why I would trade smaller and trade something with multiple units. Plus, the longer you trade, the more you'll start to find yourself scalping out and adding on. So even, and the other problem with trading E-minis is, let's say I'm trading one E-mini and I want to go to two E-minis. I'm in essence doubling my risk. So I can't trade larger than one E-mini without trading two. If I'm trading micros, you can trade one micro, you can trade 10 micros. If I want to trade more than 10 micros, which is one E-mini, I can trade 11 micros. What about an even more effective strategy than that? Let's talk about the SPY. Let's say I'm uncomfortable. If I'm trading micros, let's say I'm trading one micro and I'm buying and scaling in twice. Well, if I want to go to two micros, I'm buying and scaling in twice. So instead of being net long 3 micros, if I buy, maybe I buy and buy one, or I buy one, buy one. If I increase my position, I'm now buying two, two, and two. I've in essence doubled my risk. But if I'm trading the SPY and I'm trading 50 micros I'm trading 50 shares per entry, which is one micro, I could start trading 60 shares per entry. And anyways, back to institutions. Institutions have huge flexibility because they can really scale into positions. They're not trading one E-mini, they're trading hundreds of E-minis, or they're trading small. Or, the point is, they can their positions are very small to begin with and they can average in. Thomas says you should never have a 10-point stop. And I would say a lot of traders use 10-point stops. I know traders who will use basically, I remember I'll just use Al as an example. Al used to talk about how he would just sell and his stop would be somewhere up here. He would have an order sends order. So he'd sell at the market and his stop would be up here. And he wouldn't really look at it. He would just make sure it's not somewhere in here where he's going to get stopped out. But he would trade small enough to where the whole point behind the stop is to quickly get out of the trade if his internet goes out or something. It's just a way to protect himself. But he is going to manage the trade and get out of the trade when he deems appropriate. Let's take a look at some more questions. Well, if a 10-point stop will bankrupt you, and really, I know I see in the comments there's a lot of back and forth about micros versus e-minis. What it comes down to is percentage risk. Most traders should risk less than 1% per trade, and even 1% can be pretty high. Here's kind of an interesting question. What's your motivation behind speaking right now and explaining price action? And thanks for it. Yeah, I don't know. For me, I really like thinking about charts. And for one, it's fun to talk about it. But two, you know, for one, I mean, the second reason, I hope it's helpful. I always got to ask, when I was in the trading room, I was fortunate enough where Al was really active and, I know I annoyed the Ken for those in the Discord who manage the trading room. I know I annoyed him years back because I would always sometimes ask more than one question. And that was back when Al just had a lot of energy and was answering questions. And so I'm hoping, for one, I know that a lot of people have the same questions that I have or that I used to have, and I know I can relay the answer that Al would have given me at that point in time. And the second thing is trading is a lot of fun. Looking at charts, one thing to kind of veer this conversation for a second with trading, you have to really learn to enjoy looking at charts. If you look at charts and you don't like studying charts, you don't like looking at charts, if you're just thinking about trading from the standpoint of a monetary means, then you're really in the wrong business or industry because, if you look at and that's with anything. So for me, I like the concept of how can I better understand this chart? Can I understand all the things going on? What can I improve on? That's part of the reason why I like making PowerPoint slides. It's kind of like a playbook. What can I learn or what can I get better at learning? And it's funny. I remember in Orlando, a lot of you that were there, you probably noticed it. Even Al, who's been doing this for well over 30 years, at one point, you noticed Al would be hovered in the corner when there was a short break, and I noticed he was on his laptop and he had PowerPoint open. And even on a day he did not get to trade, I noticed he's making slides of the encyclopedia. He's taking screenshots of the day. He's got his PowerPoint open. He's drawing quick boxes, and it's almost like he's he's doing his daily review of the chart, and that's just because it's ingrained in him. So I think you really have to enjoy trading, and the great thing about trading is the longer you do it, the longer you study, the easier it really gets to start seeing all these pieces. I remember you know, thinking back, I remember times when I would look at a chart and have no clue why I did, whatever I did, I had no idea why what I did didn't work. And now I'm at least fortunate enough to know if I do something that didn't work, I generally know. So if I bought the low of this bar and I never got out, excuse me, if I bought the low of this bar and never got out, I know, hey, that's impulsive. For lack of words, you're just being stupid. You know better than that. Or, hey, I bought here, scaled in, and that's just dumb. And I always heard Al say, "Don't do stupid things, don't do dumb things." And even though I'm used to hearing Al say that, so sometimes I say it joking. You have to be, you can't be too hard on yourself when you make a mistake. One of the benefits to making mistakes is you can learn from it. So if you do something that wasn't the greatest idea, there's always something to learn. When are you looking to buy a second contract to break even? Plenty of times. I did that several times. I think it was yesterday. Let me look. No, it wasn't. My computer's going crazy. Hang on. So that was actually today. Not today. Thursday, the 3rd. So this day. I remember, what did I do? It wasn't the greatest. I bought here. It's a little aggressive. Scaled in. I believe I bought scaled in 1 or 2 points lower and decided this was going down fairly strong and just got out. I think break even on my first, profit on the second. Sometimes I'll sell above a bar, scale in, get out, break even. But in general, when I'm doing that, or over here, I can't remember exactly, but in general, whenever I'm looking to enter a second position, for one, I'm already willing to scale in before I enter the trade. I know that going into the trade. Second, it's either I'm disappointed. So when I'm trading with limit orders, in general, a rule of thumb, I want to be out of the trade in about 1 to 3 bars. So the trade's quick. You're looking to get a quick scalp and then exit as fast as possible. So, a really aggressive scalper is trying to put on, they're trying to, it's kind of like Walmart. So I'm from Arkansas, and Walmart is, and Al always talks about Walmart, which is kind of funny. I'm in Arkansas, and Walmart, I'm from Arkansas. I live in Texas now, but Walmart started in Northwest Arkansas. So it's obviously a really big deal over there. And, the business model of Walmart is basically sell everything as cheap as possible and strangle out the competition. But they make everything so cheap that they're just trying to sell as much volume as they can. And that's basically a scalper's mentality. They want to take as many trades as possible, and they know they're going to have losers, but they're not going to be catastrophic. It's kind of like, as another trader explained it, it's kind of like if you're selling a product and you're selling it a ton of times over and over and over, there's going to be returns, and you just throw the return in the trash. It's kind of like Amazon. I think Amazon, for some products, if you want to make a return or if it's faulty, they'll sometimes just tell you to keep it because it'd be more expensive to ship it back. So they've already got it factored into their, you know, their profit margin or their algorithms. They've got it factored in to just, take the loss and move on. And scalping is a lot like that. So for me, when I'm scalping, and that's generally when I'm scaling in, looking to break even, I think I did it over here. Although it was a little bit of a mistake. I sold and scaled in, and I got out break even on my first. I debated. I either got out break even on my first and a profit on my second, or I sold, scaled in, got out half right here, and then I held for a little bit. I can't really remember though. But those are often examples. Now, when I'm swing trading, I'm always going to exit when my premise is no longer valid, though. So I'm selling here because it's a wedge. 1, 2, 3, bull break out of a channel, expect 2 legs down, etc. So Thomas says they feel emotions when they're with live simulators. They feel emotions when trading live, but the simulator helped them a lot. Yeah, I think simulated trading is really good these days, and it's pretty accurate. And I think the next best thing to simulated would be trading the SPY with like one share. Okay. Question. If I can only take a trade and walk away from the screen for 10 to 20 bars, what are examples of types of trades I can trade? Well, you know, on one thing, Chase, what you're talking about is the Walmart trade. And I'm going to assume that basically what you're saying is you can occasionally look at the screen, but you've got to walk, but you can't look at it every. So let me back up. There's two questions I have for you, Chase. One is, do you have the time to wait for a setup? And are you saying that what you're asking is, if you can only take a trade and walk away from the screen for 10 to 20 bars, what are some types of trades you can take? Chase, are you asking that from the perspective of you have all day to watch the chart, but you want to take a Walmart style trade and wait for, not manage your way out of the trade? Is that what you're asking? Or are you saying, hey, I've got work, I can't watch the market all day? So for the first question, if you're wanting to take the Walmart trade and you're wanting to buy something and hold for 10 to 20 bars and go for a walk or go run an errand, that is kind of a Walmart trade. And that's a low probability style trade. It's not a bad trade, But, a Walmart trade is tight trading range, big bear bar, sell the close, put your stop above, and come back in 10 or 15 bars. Now, the other example is okay, bar 10, bull bar. Maybe this is a sell vacuum, tested these lows. I'm going to buy above and put my stop below, and I'm going to hold for a test up here. And I'm going to try and go for twice my risk. By the way, let me turn the screen off because I do want to talk about probabilities for a minute. I'm going to go back to your question though, but I do want to open up something really fast. By the way, please let me know what is helpful about these Q&As and what would be more helpful and what is not as helpful. There we go. So I will talk more about that in a second. Anyways, so the first one is try and find things, look for double bottoms, double tops, wedge bottoms, wedge tops, buy a bar, put your stop below, and go for twice your risk and just do an order cancels order. The second is what I talked about earlier. If you're in a let's say you're working, you can't watch the market all day, trade higher time frames. Trade a 240-minute chart and let's just say here's a market, big bear bar, follow through. Maybe you sell a pullback, sell 50%, or let me just kind of fix this. You get a big bull bar. So you had a breakout. The bears, they failed to get a second leg down. They got trapped here. Some will buy. Exhaustion, some take profits. And if you didn't, maybe you buy again here. If big bull bar after, so basically a bear breakout below a wedge. This is kind of what I was talking about earlier. We have a strong bear trend. Bulls clearly making money. So this is the start of the trading range. And because of that, you'll have traders, they'll look to buy any pullback. So the market sells off for a few legs, surprise bar, but the market's probably in a trading range now. And then we get this reversal. You'll have traders start buying consecutive bull bars, hold for a couple of legs. Anyways, let me talk about probabilities for a second in relation to your question. So if you have to take, this is something that's very important for traders to understand. And if you're in the trading room, you've seen me bring up this spreadsheet all the time. So let's focus on these two right here. If you had the choice, I want to ask everybody the question between these two situations. So if you had to pick between going for 1 times your risk and trying to achieve a percent profitable of 60%, or going for twice your risk reward 2 to 1, and being 40% profitable, which one of these do you think is easier for most traders to achieve? Is it number 1, which is this top one, or is it number 2, going for twice your risk? What would everybody think is an easier choice? John says 2. Everyone's saying 2. Yeah, that's exactly it. So number 1 is 1 times your risk. Number 2 is going for twice your risk. And most traders, everybody understands that this is kind of the more fun path. And if they could get a really high winning percentage, they can scalp a lot, and that's a lot of fun. But this right here is going to be the easier path. And most traders should start focusing on this path. Now let's talk about return for a minute. Point 2. Point 2 is kind of like getting minimum wage. It's the minimum acceptable to live or past college, as Al said. In Orlando, there was a little bit of a meet and greet, and I remember someone asked Al in the event. They asked Al. I remember hearing it. They said, Al, if you take a trade and your probability and your risk reward's one, can you really make money if you're only 60% profitable, or does it have to be more? And he laughed and he said, no, you're going to lose money after commission. You will not make money being 60% profitable at one times your risk. So what that means is 60% is kind of like, hey, you're not going to lose, but you're not going to make anything. You will not, there's no money in that. What that means is you really have to be 70% profitable or more. Well, what that also means, if you're 40% profitable and your reward is only 2 and your risk is 1, 0.2 is also minimum. So you need to make this return bigger. And this is just per trade. If I'm going for twice my risk, if I can make my probability, let's say 45%, look at that. It goes up to 0.35, 70%, 0.4. So if I can be 5% more profitable in this situation, I've almost doubled my return. And here, I've got to be going from 60 to 70% profitable is very difficult. Now, the problem here, I want to use this as an example. Here's what traders fail to understand about trading. Let's use try to find a good example here. Okay, let's use this. So let's say a trader is long right here. And, or better yet, let's just say a trader sells down here and they hold for a second leg, get a pullback, they're still short. And let's say they're short down here and their stop is right here. So 1 times the risk is all the way down there. So they're short, stops up here, risk is down here. You might think, hey, there's a 60% chance it's going lower. And let's just pretend for fun, it's not 60%, but let's just pretend for a minute, 60% chance we go down here before we go up here. On this next bar, it's no longer 60%. So if I had a 60% chance of making 1 times my risk on this example, which is right here. The computer's getting mad. Give it 1 second. 60% chance, and now it's less than 60. Let's say it's 55%. That is not enough to make it worthwhile. And because of that, we go a little bit lower. We get a doji, and then we get a bull bar. All of a sudden, that probability starts to shift. And there at some point, it will shift to the other side. Instead of being 60% profitable 1-to-1, it shifts. And that's right here, somewhere in here. At some point, it becomes close to 50%. Then it goes negative 49%. That's when everybody starts to bail out on the trade and it starts to go sideways. So, anyways, the point I'm making is if your risk reward, this is what I would write down for all you scalpers out there or breakout traders. If your risk reward is 1, then that means your risk reward is 1-to-1. It's your probability, your reward is equal to your risk. If it's 1, the only edge you have is you have high probability. When you lose the edge of high probability, it is no longer a good trade. You have to exit. When your risk reward is 2-to-1, your edge is low risk. You want your risk to be small and your reward to be big. That way, your probability, even though it's low, your reward offsets the risk. Okay, let's look at some more questions. Someone asked, I forgot where, but they asked about TradeStation. How do I make the measured moves? Only how do I change it up? Well, for me, when I go to Fibonacci retracement lines, or you can click drawing, and you see these numbers, these letters D, P, C, M, A, those are hotkeys. So if I click D on the keyboard, it draws a trend line. If I click M, it draws a retracement line. There's a retracement line. I have it defaulted to 100%. So if I right click and edit, I go to settings. These are the settings, and I can turn on 200 if I want to, let's say, draw a trading range. I might turn off this and just add, let's say, 66% and then 33%. Sometimes I'll just make those like a blue so it stands out. And now I've got a lower third and an upper third in the middle. So if I want to measure, a pullback in a trading range, I can do that. So question, what if you trade mini instead of micros? You say a lot about commissions compared to micros. What about e-mini, one-to-one scalping, for example? Well, you can do that, but you know, it's kind of like, I'll quote Al for a minute. You can build a house with, this is something said in the video course, you can build a house with a hammer, but if you have a lot of other tools in your tool belt, you can build a house faster. So the only problem I have with what you're saying is if you only can trade one E-mini, it is going to be more. Give me 1 second. If you can only trade one E-mini and you're limited as far as you can't scale in, it's going to make it more difficult with scaling in. So if you go back to a few examples I talked about is if I'm buying, let's say the low of bar 2, I took that buy yesterday, and I might buy the close, I might buy down here. I'm willing to buy 1 or 2 times lower, and I'll often put a measured move down on the bar. So let's say I bought the close, I don't know, the low of this bar or near the low. My stop's down here, but I'm going to allow myself to scale in once or twice, because if the market stalls, if it goes down, I'm going to be quick to exit with a small profit. So I think for the most part, scaling in is very beneficial. The other problem is if you're trading in a trading range, like right here, for example, if you sell here and you're selling E-minis, your stop's up here. High probability you're going to get a second leg down. This is a micro channel, but it's low in the range. And if you can't scale in, it makes life a lot more difficult, because if you can scale in, you can sell, scale in, get out, break even. I could buy this low. Like, look right here. If I bought this low, well, if I can't scale in, do I just get out with a small profit? It's a lot better if I could buy and scale in and get out. Now, if I was only trading one position, what would I do? I might try something called reach trades. Here's a bull bar, and I'm thinking there's buyers below. Rather than buying the low of the bar, I might try and buy around a measured move below, so 2 or 3 points below. So you get filled right there, and then you get out. Let me look at some more questions here. So someone asked about the bar counter I use. Someone was kind enough to give me the bar counter for the trading room in these kind of lectures. And they kindly asked that I don't share any of the bar counter with anyone. But there's plenty of people that have bar counters. If you just ask in the chat or go on the Brooks Trading Course forums, Several people have bar counters for TradeStation, Ninja Traders, all of the main brokers. Question: do you always take trades based on bar analysis, or do you also take chances, for example, as soon as price reaches double top? Yeah, for me, I'm always viewing things in the context of support or resistance. So, what I mean is, I'm always, I want to think about the market as this, a trend line. So, if you remember, I talked about, let me go back to the bars to freshen everyone's memory. Remember, I talked about these bars and I said this is enough to make the market a trading range. So if we go down here, we'll probably rally or at least go sideways. You can see the same thing on a line chart. We have a bear trend. We went sideways. We have a strong rally, but the rally is probably going to lead to a trading range. And because of that, traders buy, they buy more down here, and the market rallies. So let's look for another. Let's go back to probabilities for a minute. So for me, I'm always thinking about support and resistance. I'm looking at bars, but to me, context, which is support and resistance, is most important. Let's go back to for an example. Remember what I said about if you take a 1-to-1 risk reward at 60%, you have to have probability on your side. If you buy here and your stop's down here, let's say you think there's a 60% chance we're going here before price goes to the bottom of the breakout. That's probably true. 60% chance you're going to get a second leg up. Now, the problem here is if you're long, you have to get out when the probability is no longer 60%. Well, at some point, let's say you bought, look right here. This is minor. Bulls bought, disappointed. What did bulls do? They got out break even. Eventually, these bulls buy, scale in, allows them to get out break even. But notice what's happening. We went sideways for a lot of bars. So I'm going to go back to my green box, and I've always drawn this green box to show something. What am I saying right here? What is this like? What is this second leg, this rally, more likely to be? So we went sideways for a lot of bars. Is this bull bar? What is this likely to be part of? Who can answer that for me? Exactly. Matt says trading range. That's exactly right. Probably in the start of a trading range, which means there's probably resistance somewhere up here. Bull breakout, dojis, and all of a sudden, what used to maybe seem like 60% measured move up is not quite acting like 60% anymore. And because of that, maybe what happens is all these traders are going to exit quickly. And here's the problem with trading that you have to really think about. If this breakout is either in a bull trend or a trading range, let me think of a better way to explain this. Let me explain it like this. So Al always says that you should exit on a second entry at the top of the you should exit on a second entry at the top of the trading range and exit on a second entry buy at the bottom of the range. Why is that? It's really simple. If I buy up here, let's say, and I never get out, and I never get out down here, okay? So if I buy here and I don't exit here, and let's say I put my stop at this line, what is the difference between getting stopped out right here and going short? There's no difference. If you really, really think about it, there's no difference than selling out of longs below this bar, this red line, and going short below this red line. Both of them are bad trades. So there's really two ways you can manage it. If you really want to think about this from a very simple idea, you buy and you get out as soon as you think the market's not in a breakout and is in a trading range. In other words, you get out anywhere in here. Your stop is not down here. Or you take this approach. You buy. This is why traders trade really small, especially in trading ranges. You buy and you put your stop way down here. This is institutional trading kind of idea. You buy and your stop's all the way down here. And you'll add on if the market continues to go higher. Otherwise, what they'll do, they'll think, okay, it's either in a trading range or bull trend. It's probably in a trading range. They start scaling into longs all the way down. And here, what do? They buy because they know the odds are the market's in a trading range. And then it went right back to it. That messes up traders all the time, where a trader will end up exiting at the worst possible place. Had some examples of that recently. So breakout, probably a bull. It's probably going to be a trading range. So if you do get a sell off and it goes below the breakouts, it's probably the buy zone. There's one I'm trying to think of. Here's one. This was the FOMC day. Now, this is a little, for anyone that doesn't have the video course, this is one slide in the video course. It's just a screenshot that I wanted to illustrate with this topic. And this is basic. I think this is from the protective stops video using wide stops. Anyways, the whole point of the slide is what Al mentions is if you're long, the worst place to get out is down here. You exit when your premise is no longer valid. So if you're buying because it's a bull trend, you get out on this bar when it's clearly going down. If you buy here, don't exit down here. It's one thing if the sell off is just so fast you can't react to it. But if you're long right here, why are you buying? Let's do this. If you're long, okay, you buy this close and then you get follow through. Your expectation is that the market's going to go higher. You're hoping it's a bull breakout and that's going to go and lead to a lot, much higher prices. Then you get this overlap, more overlap, more overlap, even more overlap. Traders are now saying, hey, this is probably going to be a trading range. And that's also why big bull bars that are much bigger than average generally are not great bars to trade. Most of the time, it's better to wait for a pullback. And then you can see what happened. We melted. And if you go back to this day, we rallied all the way back here. So the bull that bought shouldn't be hard to find. It happened a few days, like 2 weeks ago. Let's just go ahead and pull it up. So a trader that bought there, here it is. A trader that bought and they bought more below the breakout, look right here. The market went all the way back to the high close and it allowed them out. Peter says line charts seem clear, more clear in many ways. When I realized, yeah, so the reason it seems more clear is a line chart is just a reflection of price. It's just data points. This chart works as well. Here's a line chart. Big rally, pullback, second leg. So let's take a look at some more questions. Someone says, what is a trap? A trap is a failed breakout. A breakout is a surprise. So if we go to, it's another important concept. Let's do this. I'll pull up the encyclopedia and show it to you a few trap examples. Oh, okay. You know what a trap is, but you don't see a trap here. Well, yeah. Well, if you know what a trap is and you don't see what the trap is, then you're not identifying clearly what a trap is. But a trap is anything that's a surprise that fails. A surprise should get a second leg. And if it fails, then it's a trap. Second leg traps, it's really common for second leg trap. This is a variant of a second leg trap. And while the encyclopedia is loading, we've got a lot of second leg trap examples. Yes. I'll just show the encyclopedia, it's easier. The encyclopedia is very helpful. So one thing we did there's a webinar about the encyclopedia, and one of the things about the encyclopedia to really understand is the encyclopedia is most valuable once you already understand the trading course. It's not as valuable when you don't understand the trading course. That's why there's a policy. You got to wait 60 days before you can get the encyclopedia because you really need to have a baseline of the trading course before you can use it effectively. For me, the way I got really comfortable with it is doing this. So I would go to I'd download the index. Here's the index, and I would start studying kind of where everything is. And the more you use it, the easier it gets to learn it. But anyways, back to a few things. One, traps. I want to show something. So a trap is right here. It's a surprise bar that fails. Bull breakout, it should have gotten a second leg. It failed. Now I want to show a second leg trap. Second leg traps, it's really common to get a second leg trap that goes sideways. Here's a good example. We have leg one, pull back leg two, or one of these highs is leg one, pull back leg two. But notice what happened. The market went below the bottom of the second leg and then went back to the highs. And when you think about it, that looks awfully familiar to this day. Leg one, pull back leg two. We vacuumed down to the bottom and then we went right back up to the highs. I'm glad this is helpful. And like I said, I want to start, you know, these are always a little, someone said that this is a helpful session. And, you know, I'm happy to know it's helpful. One of the things that's a little bit challenging with these sessions is everybody's at a different journey with their trading. My hope is that I want to start doing regular Q&As, but then also we can start doing some sort of maybe classroom style of discussions. So in other words, one thing I'd really like to do for those that are possibly members of for those that are obviously members of the course is I think it'd be really great and really helpful if we could take some of these videos and really break it down. So for example, what channels? Maybe we could have 3 or 4 sessions over each one of these videos and really diving deep into the nitty gritty of channels, or same thing with trading ranges. What are those key things about trading ranges? That'd be really helpful. But obviously, in order to do that, for the people that would listen to it, it would really need to be people. Obviously, you have to have the video course. And second, you really need to have spend time with the video course. So if that would be helpful, please comment below. But one of the things, and obviously, I'm hoping to do that more this month. So I don't know. Maybe it'd be kind of like a live classroom edition of the trading course where every week we really go over a video and answer questions about the video. Okay, let's look at some more questions. Question: when there is no pullback at all in a leg, do you wait or do you enter on second consecutive bars? I often get paranoid when there's no pullback and I don't know where to enter. Katie, if you are in the chat still, I want to ask you a question, and please leave this question for Katie. Katie, think about it for a second. When there's no pullback at all in a leg and you want to wait and you get paranoid, what you're telling me is you don't want to enter. You want to enter on a pullback. Think about, people already say pinch your nose and jump in, and that's exactly it. Katie, the what I would say about your question is it's a risk issue. That's why I think it's great if you can trade the SPY. You can just trade one share, and if you could trade one share of, let's say, the SPY, and you start to see 3 or 4 consecutive bull bars, you just pinch your nose, jump off the high dive, and just buy. That's one of the great benefits to trading something like the SPY is you can basically risk pennies. So I would suggest if you get paranoid when there's no pullback, for one, you have to think about why there is. For one, you've got to think in terms of if there's no pullback, why is that? So back to this chart over here. Where did it go? I know it's here. It's right around here somewhere. Let me just get it pulled up. I'm going to start organizing this better. Here it is. So if there's no pullback, you have to think about why. And that's because traders are trapped. Jack asked, when you say one share of the SPY, how do you do that on a 5-minute chart so quickly? Like getting in and out? Is there software? Yeah, well, if you're trading one share of the SPY, there's no difference between one share of the SPY and one share of the E-mini. You're going to trade it the exact same way and enter the same way. Thomas says, remember your long-term goal is to get to the ES. Thomas, I would challenge you to remember your long-term goal is to be consistent and earn money. The SPY, it's always kind of funny. Everybody assumes you can't make that much money trading the SPY. Well, there's an obvious one, and obviously one is leverage. If you're trading the SPY, and I will agree with you in this sense, if you're trading the SPY, you get 4 times the leverage based on your account, and divided by 446, you'll never be able to risk more than 1%. But even you could trade the Qs, the QQQ, that's less. And anyways, the point with trading the SPY is to be able to build your position in a very smooth way. But a lot of traders trade equities, and there's a huge benefit to it. If you pay attention to Al, he trades it all the time. But anyways, do I use Dome with the SPY? I don't really look at depth of market. I mean, for me, I've got a chart here and a matrix, which is instead of this box, the matrix is right here. That's pretty much it. A lot of traders use options to trade the SPY. I don't, but I probably will at some point. Let me find some more questions. So I'm curious, what is the, and it really answer what comes to mind. What's the biggest issue that in terms of trading you have? And if you're brave enough to answer, please let me know what it is. Is it, and what I mean by that, is it trading ranges, scalping in trading ranges, trading breakouts? Is it counting legs? Is it, you know, please give me in that way, because I want to start thinking through video topics to have for maybe a live classroom addition to the video course, as well as talking points. Do I point count like Rose? Can you share your technique? I know Rose has a certain way of point counting, and everybody's a little different. For me, I think of it as, again, I always kind of go back. Al's the only person I've really studied. So, and there's a lot of similarities between the both. And for me, I'm always thinking in terms of, I know Al, he always talks about in the books, the video course, traders take profits at increments, 1 point. And, back in, it's funny, back in 2014, 15, a lot of scalps were 1 point, 2 points, and a good swing trade was 4 points. Now a scalp is 4 points often, but it's typically increments. So it's, right now, a lot of traders take profits at 4 points, 10 points, 20 points. I often look at things as far as the increments of bars. So, for example, if I'm short on this bar, I will pay attention to 1 times the range of the bar. That's a reasonable place. And the reason why traders, count points or count distance, for me, I like to think of it more as distance counting and reversion to the mean. That's a more of a term I like to think about. And what I mean by that is, a lot of time when the market's in a trading range, you know, the reason why traders pay attention to distances of moves is price usually reverts back to the mean. That's the reason why if you use break even stops, most of the time you'll lose money. And an example is right here. Here's a high one buy. It's a bad signal bar. If you sell above it and scale in, it's a trading range. The bears are probably going to make money. And look what happened. The bears sold, scaled in, made money. The bulls that bought these lows, guess what? It's a trading range. You know, you know the bulls are going to make money. They didn't. They got trapped here. But even if the market sells all the way down here, they're going to make money. And there you go. Traders made money. So traders pay attention to distances. Like, for example, if I'm a bear, if I sold this bar and I see that the bulls got trapped here, they bought this low, they scaled in, they couldn't get out, but we have a bull bar here. There's one thing I know, I'm really confident it's going to happen. If we go down here, we're going to go back to this area. So I know, hey, if you're short, scalp out, because if you don't, you're going to be right back to where you were in a matter of a few bars. And that's what happened. So, okay, great examples: management, closing trades, staying into winners, all helpful. I like John's question. Biggest issue for me is trade management. When do I get out? How do I decide to get back in on resumption? And, that really gets into always in trading. That's definitely going to be something I'm going to talk a lot about, or that I want to talk a lot about in these upcoming videos. Is always in trading is very, very important to understand how to trade. But I will definitely cover more of this. Trading psychology. Yeah, that's also a good one as well. Richard, I know Richard wants to talk a lot about trading psychology. Most of you know Richard. He does basically everything on the websites. And, without him, the website probably would not even be running. So everyone should thank him for that. But as far as trading psychology, I'm not the best person to ask with trading psychology. It is important. And, for me, I've always believed that the more I learn about a chart, that the more I can correct my psychology. And there's truth to that, but there's also truth to, you have to learn how to be less impulsive and, happier with what you're doing. But we can definitely talk about that. This is a extremely important one. Regina, this is something everybody should. I'm trying to think of the best way to do this. So let me do this. This is a very good conversation, and I want to talk about this for a minute. So let's pull this up. So let's do trying to think of what we want to say here. So like 1, 2, give me 1 second. Leg 1, leg 2. Okay. This is kind of be a fun little, say, quiz question. So this would be something to really write down for the most part. And this is breakouts of legs. So BO breakouts. When the market's in leg 1 of a breakout, and let's just say percent probability. Better yet, let's do this. I'll explain why I'm doing this in a second. Leg 1, for the market to get a leg 2, and basically what I'm betting on, the percent probability of a another leg. Let's do it like that. When you have a leg 1, in other words, a breakout, that's the first leg. A good example is 2 days ago. Really, it's right here. This is a breakout. This is leg 1. There's a high probability there's going to be a second leg. And because of that, you probably got, just on the simple fact of the market going, let's do it like this. The probability of the market going 1 tick below this low, in other words, selling, scaling in, is often 90%, somewhere in that ballpark. Now, the second leg is very context dependent. So the probability of leg 2 getting a third leg, maybe it's 60%. It's not 90% at all. So what's really important to understand is you can almost always, on leg 1, enter the breakout and scale in for a second leg. You can sell, scale in, get out for a second leg. This might be a second leg trap, but the reality is the probability of selling, scaling in for a second leg is really high. Now, when you're at leg 2 or leg 3, you should almost never consider taking leg 3. So leg 3, this basically means a wedge. 3 legs are almost always a wedge. And you should almost always exit when there's a wedge. 3 pushes down, 1, 2, 3. This is probably going to fail. Now, there's one example where wedges almost always are, when wedge, it's really bad to fade wedges. So let's think about this. Parabolic wedges are minor reversals. When should you never bet on a wedge top? There's one type of formation, or a wedge bottom. What type of market is always forming wedge tops? Who can answer that? What type of market is always forming wedge tops? Small pullback trend. Jack got it. Yes, small pullback trends are always forming wedges. So let's talk about leg 2. I said leg 2 generally gets a third leg down. And I'm just going to say low for this. The point is, when you get leg 3, if anything, don't take. So I'm just going to say do not take. Because you should almost exit on wedges. Now, let's talk about second leg traps for just a second. Why are they relevant? They're relevant because the second leg is very context dependent most of the time. It's like right here, big sell off. Look to the left. You're in the middle of a trading range. You're all through this area. You have a big sell off right here, climactic bars. What did I talk about with the green box? Right here. I said that bulls were making money, right? So if bulls are making money here and you're getting this downside move, that's a second leg. But often in a trading range, another thing to write down is you should almost always on leg two, do not, at least in a trading range, do not scale in. You have a second leg in a trading range like this. You remember hearing Al say that it's a buy the close rally or sell the close rally, but I would get out above a bear bar. That's often because it's usually some form of a second leg and there's a greater risk of a deep pullback. So for me, I would generally consider not, excuse me, I'd be very careful about scaling in here because if it is, sorry about that, if it is a second leg, you can get a very deep pullback. So let's go back to the encyclopedia for a minute. So here are second leg traps. Second leg traps in trading ranges, because they're in trading ranges, they have a high probability of going sideways and failing. So that's why it's dangerous to scale in. The scale in window is really short. Bulls buying, scaling in, getting out basically break even on the trade. Big rally, sideways. Big rally, sideways. Leg one, pullback leg two, but top of the trading range, it went sideways. Let's look at failed leg, second leg traps. I want to look at second leg bull traps that failed. What do you notice about here that's so much different? I said most second leg traps don't scale in against, or it's good to get out. That's why Al has this marked. It's a second entry after a second leg trap, and it could lead to a trading range. Instead, it failed and it led to a bull trend. Here, second leg trap, leg one, pullback leg two, or leg one, pullback leg two. But look, tight trading range, strong breakout above. We may get a couple of legs up. Here, why is this not a second leg trap? Leg one, pullback leg two? Because we had a strong breakout and it's closing above a lot of bars to the left. Anyways, the whole point with this, most traders should focus on the first leg getting a second. So big bull bar and then a bear bar, high probability buyers below for a second leg. Big bull bar here. This is not ideal to be buying and scaling in. And the reason is it could be a second leg trap. Second leg traps are very, very common. They're very minor at times. They don't look traditionally like a second leg trap, but they're fairly common. So big bull bar, bad follow through, another big bar. And that's a second leg trap. And the reason why it makes sense to get out pretty regularly is you don't want to exit down here. Remember, if there's another thing you could write down, whenever you're trading breakouts, breakouts are often either what? They're either breakouts in a trend or breakouts in a what? So who can answer that? Trade range. Jack said it again. Breakouts are typically either in a trend or a trading range. So if this is a trading range, where do I not want to exit? At the bottom. So if I'm long, I have to think about it like this. The one place, let's just let me do this. Make this easy. draw a trading range. Okay, so here is a trading range. There we go. Here's the upper portion. Here's the lower portion. Okay, and let me just extend this to the right. Okay, so this is either a trend or a trading range. Now, if this is a trend or a trading range, I know that the bottom of the range is here. So where's the buy zone? It's down here. It's going to be this box down here. So I'm going to make these blue for buy. And because of that, I really don't want to sell in this area. Big bear bar. Why is this going down? Because the market's probably in some kind of a trading range. Reversed up, came close to the bottom of the range. Big bar. Is this where you want to sell? You can, but 2 legs down. And there's probably buyers somewhere in this area, but the buyers might not come in until all the way down here. Consecutive bear bars. Hey, isn't this where you want to sell? So why don't we sell here? What did I say about second legs? Leg 2. Here's leg 1. Here's a pullback. Leg 2. Big bar, another bar. Leg 2 is dangerous in a trading range. Do not scale in. So if you're short here and you get a bull bar closing on its high, take your medicine and exit the trade. And that's why, because it's a buyback, it's a sell vacuum, test of support, and the market reversed. Now, how do you differentiate strong legs or strong breakouts from weak legs or weak breakouts? This right here. I want everybody to write down this day, April 28th of 2022, 5-minute chart. Matter of fact, I want to help everybody out. I want everyone to copy that day I just put in the chat. And I'm going to copy it right now. I'm going to go to April 28th of 22 at es.d. I want you to print this chart out and put it on your wall, put it on your computer. And basically, I want everybody to draw a rectangle right here and print this chart out and hang it somewhere. And I want you to hang it and remind yourself what a strong breakout looks like and really study these bars. There's lack of overlap. How does this look compared to the day we were just looking at? Right here. Bar, bad follow through, another bar, big bar. This is not the same. All right, let's look at some more questions. I really like this question or this comment. They say, my biggest challenge is letting my winners turn into losers and not just losses, but huge losses. I keep hoping the market will come back and then it doesn't. Let me get a sip of water. So, this is a very interesting conversation. And one is, you know, really, let's start with the first piece. I have a problem with letting my winners turn into losers. And most of the time, the market's in a trading range. So if we think about that logic for a second, that means that most of the time, if you are, what that means is most of the time, your profit will turn into a loss. Why? What did I say about limit order traders most of the time? Who makes money more, limit order traders or stop order traders? In terms of frequency, who can answer that? Exactly. Limit orders. Now, that means most of the time, it's kind of, I always kind of joke about it, but I remember hearing Al in the trading room. He would always say, break even stops are really stupid, and there's no mathematical basis for a break even stop. So if you are buying, like right here, great example, you buy, the market goes up, move your stop to break even, and you get stopped out right at the break even price. And he said it's really dumb thing that happens, and there's no mathematical basis. In a trading range, the market's gunning for those stops. And the reason why is this is what traders do. They see a bar and they basically buy back shorts a distance below. So the market goes down and they buy back shorts. Big sell off, deep pullback, market goes sideways. So, anyways, the point with that is most of the time the market goes up for 2 or 3 legs and then reverses. In a trading range, the reason why I say don't do not take leg threes is most of the time a 3 legs is a wedge, and wedges are trading ranges. Here's a trading range: 1, 2, or 2 and 3. Or, as Al always says, it's a failed bull breakout of a wedge: 1, 2, 3, and maybe 4, or 1, 2, 3. The point is, this is a lot more dangerous than it appears. It's a possible third leg up in a trading range, and there's a higher probability this could fail. Now, how do you deal with the second part of your question? I keep hoping that the market will come back and then it never does. Well, what you're doing is you're not trading the market cycle correctly. A limit order trader is, let's think about, let's do this for a second. So I'm going to try and find this as I'm talking. Does anyone remember, it happened over the past 2 months, the day where we had 25 consecutive bear bars in a row on the open? I don't remember the day, but this is a good example. Traders are limit order traders are basically, they're fading breakouts. But the reality is, if you're a limit order trader, what are you going to do? Even institutions that are using limit orders and fading everything, you know that once the market switches to breakouts or stop order trading, like here, they're going to start buying aggressively. So the way I think about it is, for me, I want to follow the always in direction in the market cycle. So here we have a breakout. If I go back to, just going to pull up my handy dandy flow chart. Okay, so we have a breakout, and let's do, here we go. So here's is the market in a trend or a trading range? And the market, it's in a trend. So is it a breakout or channel? It's a breakout. So I'm going to go to part A. Is the breakout moving far beyond support or resistance? Yes, it's moving above all the bars to the left. Okay. Yes. And I don't know, let's say, what's the probability of the breakout? At least 60%. You can buy and go for actual risk. That's not actually, let's do this. That is not the right flow chart I'm looking for. The bad part is I've made so many flow charts at this point that I forget which one it is. But anyways, it's binary decisions. In the if we think back to the trading course, a breakout, what do you want to do? You want to find a way to get long and enter at the market. So buy the close, stop below, enter something. So if I'm short and the market's clearly always in long, that is an invalid trade. It does not compute. I cannot do that. I have to get long. An example was actually yesterday. This should not have happened. We have a bear trend. Well, we have a bull rally that was weak, lots of buy climaxes, and a parabolic wedge. 1, 2, 3. It's a micro channel, so it's a breakout on a higher time frame, but we probably should have gone more sideways. So these levels down here should have been support. Somewhere over here, the market should have stalled and just gone sideways. Here, maybe here, somewhere in here. Tight channel, so first reversal up's minor, and then we get a bear bar, but then we get this big bar. Could it be exhaustion? It might, but it's a possible bear breakout below a bear flag, so we may get a measured move down. And then we got this huge bar. But even the traders that said, yeah, this is really breaking out to the downside, I'd need to sell. If they sold anywhere in here, look at it. It kept going down. So the point is, like over here, there was a day in January. It was earlier in January. So let's do 1/10/23. It was January. Here it is. Yeah, this was that day. So we gapped up and we have a big bar one. And if you're a bull, let's say you're a bear, you sell here, you sell this close or this bar. First off, can anyone tell me why this bear breakout just based on these three bars? Ignore this gap up. Can anybody tell me why these three bear bars are not that great of a breakout? What makes this a lower probability breakout, even though the bars are big? The bars are blank. One word, starts with the C. Context or trading range is right, but it's not what I'm looking for. Starts with a C. Next letter is an L. Climactic. There we go. The bars are climactic. They're big bars. And because of that, it's an increased risk of a sell vacuum. Now, the odds are, whenever you see this, you're not going to have a bull trend. But when you start to see this bar, and then this bar, and then this sell off, this is not behaving correctly. At some point, you have to exit your short. A lot of traders, if they're short, they know this is either a bear trend or a trading range, more likely a trading range. So when you get this big bar, a lot of traders, what do? They exit because they know the market's probably just going to go sideways here. And if it's just going to go sideways, they really don't want to be short because the market could go all the way up here. The way I think about it is this. I'm always thinking about stop placement versus my risk. So if I'm short, what's my target? Let's say it's the low of this bar. Where's my stop? If I sell this close, target's here and stops up here, I can't do that because it's not 60%. If I put my stop up here, I'm still not certain that the probability is 60%. So the point is, traders exit because the risk reward, the probability of the market going all the way down here before it goes up here, it's not 60%. So they have to get out. Let's see here. Let's look for some more questions. People keep mentioning the Best Losers Win book. I believe that's is it Trader Tom? I'm forgetting his name. but I know a lot of people like him. I've never studied anything about him, but I know he is certainly popular. Jack says the hardest part for me after a string of winners making myself stop making a stupid trade or getting out too soon, for lack of better words. Yeah, I think it's easy. You get a lot of winners under your belt, you start getting a little too confident and you start to, do the wrong thing. That certainly happens. Another one, someone mentioned holding losing trades for longer, exiting the good trades quickly, and leaving, and then having trouble getting back in again, thinking the market will reverse in the opposite direction. Very common in trading ranges. That's definitely a topic we will talk more about in these classroom sessions. A lot of people saying counting legs, risk management. As far as risk management goes, in general, Al says never risk more than 1% on any given trade. Never risk 1% initially or up to 3% on any given trade. I view it, for me, you have to think about there's a lot that goes into risk management. You have to think of yourself like a business and, when is the investor money going to get cut? So if you're trading, how long, can you afford a 50% pullback? A lot of traders, give me 1 second, got a sip of water. A lot of traders, they like to think, oh, I'll just risk 1% or 2%. But what you got to think about is what is the allowable drawdown? In a hedge fund, for example, a hedge fund might have a tolerance of 15%, let's say. And what that means is at 16%, they will have investors picking up the phone and calling them and saying, you've lost 16% of my money, send me a check, I'm out. So you've got to think of yourself the same way. You've got to ask yourself honestly, how much can I afford to lose? It's kind of like I'll use Apex or prop firms as a good example. A prop firm, for example, Apex, I don't know many of them, and for me, I think Apex seems like the most popular one. Now, again, I'm not promoting Apex. I know if you're going to use a prop firm, please do your due diligence, really understand what you're getting involved in. But I'm going to pick up. I'll use Apex just because I'm more familiar with them than any of the others. A prop firm is kind of the same thing. They're saying, "Hey, we're going to give you $100,000, but the max you can lose is $6,000." Well, what that means is what they're basically telling you is, hey, you got $100,000. Here's my money. But if you lose 6% of my capital, I'm picking up the phone and I'm ending our business relationship. So, what that means is you really have a $6,000 account. If I'm a hedge fund and someone gives me, you know, let's say, who knows what, someone writes me a check for $100,000 and they tell me, there's going to be an implied number where that investor's going to panic. If you're, let's pick some of the, let's pick if you're a, who knows, BlackRock, or let's say you're an institution and you're in charge of a insurance company, or you're in charge of a pension plan for a teachers union, who knows. But whatever it is, there is a allowable threshold that you can risk. And if you go over it, you will lose your funds. And that is, nobody can escape that. So, sure, you can say my risk is 1%, it's 3%. But the reality is, can you really accept? You have to think about what is an acceptable drawdown that you can really stand to lose. So let me see here. Would you follow and trade two multiple indices at the same time? Yeah. So would you trade two markets at the same time? You know, I think the more one really understands trading. You always heard Al in the trading room. He would say that for him, he used to take a lot of trades on several markets during the day, but then he came to the conclusion that he would not make any more money than if he would on a 5 minute chart. And that's because there's just so many trades you can take. There's so many different trades you can take on a 5 minute chart. But what a lot of traders, I think that will naturally will do, they'll start taking more and more trades on a 5 minute chart. But then eventually they start going to higher time frames. That's why I'm a big fan of Forex. If you're looking at a 240-minute chart of the euro versus the dollar, we know that the euro has been selling off. And if you've paid attention to my blogs, I mentioned that the July 6th high is important. Here's July 6th, the signal bar. It was a good signal bar. It led to a strong rally, and we had consecutive sell climaxes. This is probably going to evolve into a trading range. And I mentioned right here that I thought we were in a trading range, even though it's not yet clear. If you go back to the spreadsheet that we made a few minutes ago, we have leg one right here, pull back, leg two, pull back, leg three. Third legs are really dangerous to trade. So when you have a bull bar right here, a lot of traders exit. And then you got this bar. So if you're looking to trade higher time frames, what can you do? A lot of traders, they'll pay attention to daily charts and 240-minute charts, and then they'll distill down on a smaller time frame. By the way, outside bars are trading range bars most of the time, and they're really dangerous. So when you get this really big outside bar, it's really dangerous to sell the close of the bar. But it's a strong enough surprise that it led to a second leg. Notice here, you sold the close of this bar, you still got a second leg down. But if I was going to trade multiple markets, I would pick a 5 minute chart and then maybe pick like a 60-minute chart or a 240-minute chart. So let's say, take a look at some more questions here. How often do you refer to the encyclopedia to get an idea of the rest of the day? I'll often think about it. How often do I pull up? As far as, do I pull it up every day? No, but I've also looked at it quite a bit, so I can often remember certain pieces. Like for example, if you get a trend from the open, so if we go to, doesn't matter, gap up, gap down, but let's just go to gap up. Always forget gap up. Go to here. I know that it's GU E1B. Let's just say up. Now, one thing to note: whenever you get a big gap up, there's a higher probability of a bull trend than a bear trend. And especially if you get full follow through, it increases the probability. Give me 1 second. But in any regard, I often remember and think about this slide. Bull trend from the open, there's a 60% chance that the market's going to evolve into a trading range. Now, why is this? Who can tell me why there's a 60% chance that the market evolves into a trading range after on a trend from the open? Starts with one word and it starts with a C. Who can answer that for me? Why do trend from the opens 60% of the time do this? It's not consolidation. It's not confusion. There we go. Nate got it right. Climax. Climactic behavior is what? Is climactic behavior sustainable? Yes or no? No, of course not. Climactic behavior is unsustainable. The reason why these moves happen is when we really zoom in, it's a biclimax, another biclimax, another biclimax. There's nobody left to take the other side. I saw someone asked if I can find it. Let me see here. Let's look. I'll talk about my favorite entry in a second. Someone asked, what's the best way to practice? Here we go. What's the best way to practice? And one of the best ways is there's a few ways. One, I often talk about for the trading course, your goal should be this. Your goal with this, you should be the trading course kind of specialist with the information. So if I was to hand, let's say, Thomas, if I was to give Thomas, and tell him, I want you to give a lecture over the measured moves, leg one equal leg two. So pull up various charts and give me a lecture over this. You should know the video course so well that you can do that. If I go to the market cycle, I want Floyd to give me a lecture on always in, slinging and scalping. So the measurement is, can you give a lecture over one of these videos? That's a good sign that you understand the market. If you listen to Ali Afshari, he did a YouTube video with Faisal, and I'll put since we're talking about it, let me see here. I'm going to go ahead and, as I'm talking, I want to pull it up because it's a really good interview. And Faisal also did an interview with Al Brooks a couple months back. But it is, pull it up real quick. Give me 1 second as I'm getting this pulled up. I'm going to share this in the chat. That is a lecture. That's a video. I don't know if you can actually click the link. Let me know if you can't click the link. I'll also put it in Discord for those of you that are in there. So I just put it in the All Things Trading Discord. So take a look at it. It's right here. You can click on it. But anyways, one of the things that Ali said in the interview that I thought was really interesting is he mentioned that a good benchmark for a trader is, can you give a lecture? Can you talk about a chart for 30 minutes? And can you talk about all the details? Can you really explain? Can you go bar by bar and explain what's going on? So your first goal, I'm trying to, as far as homework and things to do, your first goal is, can you explain any one of these videos. If I was to quiz anybody in this room, what are the main bullet points of scalping? Or, better yet, let's pull up the breakouts video real quick. Can anyone tell me what the signs of a strong breakout are? So if I go to here, click on this PDF, does everybody in here know the majority of these? If you don't, then you're missing out on information. The other piece, overall, that's most important is you have to just spend a lot of time thinking about the market. The more you think about it, the easier it becomes. My opinion on selling the close of 32 yesterday. 32? Yeah, there's a few problems with it. One is, why are you selling? So, if Carlos, if you're listening real quick, can you tell me why you sold? Please allow Carlos to answer this real quick. If you're selling, what's your premise? You're selling in a small pullback trend. And what have the bears done? So look at the past, look at all these bars. Tell me one area for anybody, question for anybody. Tell me one area since bar 9 that bears made money selling below a bar. And the answer is they haven't. So Al in the trading room, he used to always say, and he still does, I never want to be the first trader to do anything. So if the bears are not making money below bars, I don't want to be the first bear to make money. It's kind of like this PowerPoint slide I showed over here. You don't want to be the first bull to make money on a stop entry because the market can go it can still go lower. All right, I'm going to answer a few more questions and then we're going to wrap this up. But be on the lookout for on the website and Discord. I'm hoping to this week perhaps discuss a more in-depth topic, maybe always in, or maybe a deep dive in one of the videos. So I'm hoping this month we can start a version of the classroom edition of the video course. So live discussions of the video course with answers. And that would allow, in other words, my hope is to a degree, obviously, the video course is an amazing tool and there's no point in reinventing the wheel. But my hope is we can talk about, maybe have little lectures over some of these key points. So, personality traits of successful trading. Why is it important? How can we use it? And what can we do to, maybe we can make this the first video 1 of the classroom discussion. But what can we do to, how can we use these bullet points in our trading? But overall, so that's my hope. And I want to do that sometime this month. Let me take a look here. So let's find. Is there any final questions someone wants me to ask? And okay, so I'm glad Thomas says that he likes that they enjoy the free flow type presentations. Well, let me ask you this. Let me ask for before people type questions in. And could I get a vote really quick on who would rather have these free form presentations where it's answering questions, or who would rather have a structured classroom discussion. And if it's a classroom discussion, there's going to be less time for complete Q&A. So, in other words, if it's going to be a classroom, then we can't spend, this long obviously answering questions. But if it's going to be, we could do some sort of both though, a short classroom and short um, Q&A. So in other words, would more people rather this be free flow or structured, which is classroom style? So it looks like we're getting a lot of both and free flow. I would love to do one-on-one, but unfortunately, that is would not. It would take too long, and there's a better use case for. One of the problems with one-on-one is you will learn a lot by just listening to questions being answered. That was one of probably the single best things about the trading room. It was never one-on-one with Al, but what was great about the trading room was he was talking and you get to learn all these little bits of information. Okay, somewhat Diego says free, but defined by topics. Yeah, okay, so that's I kind of like that. So maybe a little bit of both of some form of topics and then maybe a Q&A around those topics. So, one of my hopes is we can do something like we'll take the we'll take the videos over, let's say, the breakout videos or trading in a trading range. We'll take all these videos and then discuss them in a classroom style with questions. So we'll highlight the topics, talk about the main points, and then we can answer questions over them. So maybe a little bit of both. Oh, thank you. Favorite setup question. For me, my favorite setup is probably a breakout. And I really like, let me think here. My favorite one, it's definitely going to be a breakout, but it's also going to be I like a lot of trades like this. So you get a sideways bar, a bull breakout, bad follow through, then a bear bar, and then a sharp move down. Those are always nice. One of the nice things about these big sell-offs right here is there's going to be a second leg. So for me, I really like strong breakouts that have a dominant feature to them. So for example, something even like this, 3 or 4 bars up, because there's a lot of limit order buys afterwards. The other thing I like is consecutive sort of sell climaxes, kind of a wedge bottom, 2 or 3 legs down, and then a 3 bar rally. So something like this. So, okay, we'll plan on some sort of maybe a structured class. So maybe like a 30-minute classroom discussion followed by Q&A. I think that seems to be the a fair medium. You know, thank you. Someone said that they appreciate the no time limit and selling of other products and whatnot. Yeah, I think one of the things it kind of goes back to one-on-one. I mean, there's limitations obviously for everything, and obviously I have more time today, but I can't obviously promise 3 hours or 3.5 hours of talking. But there's a mutual benefit to all of this, and overall, I know it's something that's definitely helpful. Jack asked, "What's my favorite ticket or market?" I don't know. I really like the SPY. I like the micros and the E-mini as well. But, you know, one of the benefits to the SPY is the commission's low. And I like also the NASDAQ though. So the SPY, if you can take a lot of trades, then you can almost make up for the missed leverage. But also you can also trade the Qs. For currencies, I don't trade currency futures. I do look at a lot of Forex markets, though. We will talk about second leg traps and breakouts. NQ, someone said it's a wild ad. NQ has a lot of it moves a lot. So if you look at it, if we look at the NQ, let's just take the volume on the QQQ, or I'll just do the NQ. It doesn't really matter. The volume on the daily chart of the NQ is 762,000. And if we go to the volume on ES, it's going to be obviously more. And one of the things about the NQ is, let me get a sip of water. Almost forgot where I was going with that. So one of the benefits to the NQ, there's give and takes. One is the volume is less on the NQ, but the moves are bigger, so you're going to trade smaller. The ES, the range is smaller, but the volume's greater because traders are going to trade larger positions. And yes, Thomas is right. The NQ will trend more frequently. The NQ obviously has a lot of technology stocks like Apple, and those have typically more volatility. If you think about it, the S&P or the E-mini, there's a lot of older stocks and companies. There's 500 of them. So not all companies, there's a greater mean, in other words, greater sideways or mean reversion. You'll have some companies going up, others going down, keeps the market more sideways. So let me look for, I'll answer one or two more questions and then we're going to have to wrap this up. Okay, here's one. That's a good one. How often should I look at charts? Whenever I look at charts too much, I get analysis paralysis. Well, there's a difference between looking at lots of charts to trade versus studying charts. You should always be studying charts and, you know, pull up PowerPoint slides on your phone. One reason I like making PowerPoint slides, I can constantly study these slides and really think about them. But another thing is that I would always look at charts. Your goal is to, I mean, if you want to be for trading, there's a requirement. There's something that's got to be, there's a due that has to be paid. There's a price that has to be paid. And that price is a lot of time looking at charts. If I trade the SPY, it's on a 5-minute chart. How many scalps per day or swing trades? I typically take a lot more scalps in a day. So it also depends on my energy level. But I typically take more scalps than swings. I'm a lot faster to get out of get out of trades than I'm a lot faster to get out of trades, and I'd often rather re-enter. All right, let's see here. So thanks everyone for watching. And like I said, pay attention to, there's a link in the Discord chat or in the YouTube chat for Discord. So you can go there for more information. Obviously, the easiest place to find information is going to be the Brooks Trading course. So go there. There will be more information about more of these classroom style teachings and more Q&As in the future. But thanks everyone for watching, and I will talk to everybody soon. Hope everyone enjoys the rest of their weekend.